a banking crisis is a crisis of the banking system. This was a banking tremor.
The worries about the large banks is over. They're resilient.
It looks now like we're certainly on the mend.
The last thing the Fed wants to do is suggest that their work is done when it may not yet be done.
Something's got to rebalance here, and it's the Fed rate hikes cooling the economy off.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Back in New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures on the S&P 500 just about unchanged. Picking up on Monday where we left things on Friday. Looking ahead to more bank earnings tomorrow. Bank of America. And then, Tom, it's on to the likes of Goldman. Then you get regional very quickly through this week. And I think the regional banks will be the big focus after we learned on Friday that these big banks, these major institutions on Wall Street have been a port in a chaotic storm in Q1.
It's a day-by-day tick, and we've got a wonderful story out of Zurich this morning. Again, it's a different story, but in Switzerland, Credit Suisse still sees some flow challenges, and yes, that makes it a very different earnings season, even as you get out to the small caps, those removed from this crisis, and those part of it.
2 data points. I'm not talking about CPI or payrolls. I'm talking about the borrowing data from the Federal Reserve on Thursday and the bank lending data from the Federal Reserve on Friday. Now, Lisa, when you put those two things together, do they signal not an all clear, but some stabilization?
Stability. This is sort of the word that's soothing markets into a feeling of calm, and that's perhaps what's giving a sense of a lift to equities. We shall see. Today we get Charles Schwab and we get M&T. We get a whole host of other regionals. I'm actually most interested about some of the regionals, given the fact that there still is this concern that big banks are simply cannibalizing the business from the smaller banks, and that's where we're really going to see the big restrictions in lending.
The big conversation, I think, in the world of economics on Wall Street at the moment is whether we can return to focusing on traditional economic indicators and move away from the banking stress of the last month. I think a lot of people in the Federal Reserve might say it's too soon to do so, but Lisa, certainly that's the focus for economists on Wall Street right now.
You know, even before this, hold on a second, even before this, if we were talking about the University of Michigan Sentiment Survey as being the main bellwether, and then
why
after
Fed
that,
expectations
exactly,
too. Yeah.
And how about after the job openings, the JOLTS survey that people had previously debunked as being highly ineffective at really gauging the actual number of openings, because a lot of people post a ton of openings that they don't fill simply to get a whole net of applications. So there's all sorts of questions over what we're actually looking at, what narrative we're forming, and whether it's all post facto anyway.
The point is, it's narratives.
It's been building over the weekend, hasn't it?
I'm just frustrated.
Did you get the feeling, Tom? It's been building over the weekend.
It's been a mess. I'm trying to understand this.
Good morning, Bramo.
Thanks. Good morning to you too. Go ahead, Tom.
She's pounding the table over there. I think that all in all, is Urian Timmer at Fidelity led off with his wonderful note. It's a bifurcated tape. It's a split market, and it's not narrative, John. It's narratives plural. You can really find your 28 flavors of where we are coming out of this pandemic right now.
If you want to get gloomy, we can get gloomy really quickly.
Yeah, exactly.
I can pick up on inflation expectations from you, Mitch, from the NY Fed, from last week, Lisa. I'll raise you. Delinquencies reported by some of the banks, credit card balances being rolled over to another month. Those are the kind of things that people start to do, Lisa, when things start to get a little harder.
Yeah, sure. And then you look at the actual jobless claims and the idea that, yes, they're taking a little bit higher, but people are still employed. And you take a look at earnings, they're not that bad.
I'm going to give this to Business Insider. I can't remember where I saw it. There's no slow time in the Caribbean anymore. All because of the pandemic, everybody started going to the Caribbean in the summer. And you know how you're supposed to get slower hotels, slower airlines?
You mean off-peak?
Off-peak, that's right.
Okay.
See, I don't do it enough, but
sure.
Off-peak is gone. And that's the boom economy.
I like that, slow
That's
time.
another, example.
I was wondering where you were going with
economy.
that. Okay.
No, it's a boom economy thing. That's all there is to it.
I'm with you. Equity futures on the S&P 500 just about unchanged. Let me give you a flavour of the price action just quickly. Equity's not doing much, but we'll get a ton of bank earnings through the week. Lisa's going to go through the day ahead, the data, the bank earnings, all of the above in just a moment. Your 10-year yield, 353.37 on a 10-year. Lisa, yield's just a little bit higher.
All right, so today, as far as the economic data, we get 8:30 a.m. Empire Manufacturing Survey, which actually will be really interesting because we'll get the first read on what we've seen in April. The real-time data aspect is going to be important. 10 a.m. we get get the NAHB housing market index. Do we see home builders starting to get a little more optimistic? Because mortgage rates have gone down. Again, this is sort of the conundrum of if you get a foot off the pedal with respect to restrictions, you end up with perhaps a greater heat in the economy. Today, we've got central banks speak, including ECB President Christine Lagarde at the Council of Foreign Relations, Bank of England Deputy Governor John Cunliffe at Innovative Finance Global Summit, and Richmond Fed President Thomas Barkin. Also, I do want to note, we get M&T, and we get also we get U.S. Bank Corp later on this week. We also get Charles Schwab coming up before market. Schwab was going to be really interesting. How much are they continuing to see outflows at a time when it's not necessarily credibility? This is a question of simply, if you can get 4%, 5% on T-bills, why are you just holding it in cash?
Yeah, not just about return on capital, but also return of capital, which was the story of the stress of the last month or so. Greg Bowder was with us in the studio listening to all of this, wondering whether he should hide under a rock and run away. But he's already there, because Greg Bowder of BNP Paribas has the price target on the S&P 500, 3,400. So did any of this resonate with you, Greg?
Yeah, I think there's a ton of challenges out there in the market, and I think this idea of a bifurcated market, things moving in different directions, is why we find ourselves with an unchanged market this morning, which is symptomatic of what we've seen over the last week or so. Very low realized volatility environment, but things going on under the surface.
Fed borrowing data, stable last week. Bank lending data on Friday, picking up again. Some positives. Lisa talked about the word stabilisation. Is it too early to sound the all clear?
I think maybe. One of the things we saw on Friday, which I thought was incredibly interesting, was we saw some of the first banks report, some of the larger banks, Citi, JP, and we saw positive price action. Typically, when you look at sector trends through earnings season, you see the first names report, the bellwethers, and the whole sector tends to move a bit. What we saw on Friday was the exact opposite of that. We saw some of the bank ETFs, KRE, KBE, that are representative of the broader industry, down on the day with the big names up. And that's the story of relative winners and losers, bifurcation. So I think there's still signs of stress under the surface, and we'll hear much more from some of those smaller mid-sized banks this week.
I'm going to suggest the narrowness of the market is in search of persistent cash flow. If we get all this gloom to occur, do those persistent cash flows break?
I think so. One of the things that we've seen this year is a very narrow rally in terms of what's driven the market. It's been a handful of tech names, growth stocks, that have really provided the index point impetus for the S&P. The question is whether these names are going to continue to trade like bonds, or whether they are actually more cyclical than the market is giving them credit to. And that's one of the things that I think is going to get tested this year.
I mean, and it comes around to big tech and revenue growth. I looked at J.P. Morgan. This is from Keith Horowitz over at Citigroup, folks, and the revenue build-out of this ginormous company, I think, is not really understood. 116 billion pre-pandemic revenue out to 163 billion, just minting money. In the era that we're in, and quite frankly, the French securities history's expert at this, do you just get almost a monopsonistic move to fewer, stronger companies? Is that where we are out 3 to 5 years?
I think there's definitely a trend at this stage in the cycle for balance sheet and quality to be a theme. I don't know if it's a longer secular theme, but I think when you're at the point when recessionary themes are starting to grow and funding costs are becoming higher, sourcing funding is becoming more challenging, then you certainly get a flight to quality that tends to be the bigger names in the US.
Let's talk about the smaller names, the regional banks. Just reporting M&T Bank. Lisa, you've been focused on this one. I'll just start with total deposits, which has been a big focus, of course, for the financial industry over the last several months. The first quarter deposits, 159.1 billion at the end of the first quarter, Lisa. That's just a touch lighter than the estimate. What else do you see here?
The fact that provisions for credit losses also were higher than they had expected, $120 million, but not much. The estimate was $118.3 million. That said, they beat when it comes to net interest margin, which came in at 4.04% versus an estimate of 4.03%, basically in line. But you also saw profits actually come in just a touch higher than expected. So does this give you comfort, right? And I guess that's one question, and I'd love to get your thoughts, Greg. At what point do you start getting more optimistic? At what point do you say, okay, this is the all clear?
Well, I think we can get the sense that maybe we have a little bit more comfort. I don't know if optimism is the right word, but the question is how much of this is stress in the banking sector is reflected in the broader market. When we look at where the S&P is trading in terms of the spot level now versus where we were going into the crisis, when we think about it in terms of valuation 18, 19 times 2023 earnings, depending on what number you want to use. There's not a lot of stress for the broader market that's actually priced into the equity market. So, we've had a relief rally off the lows in terms of March. I'm not sure that regional banks themselves finding some stability is enough to really help the market from here.
Okay, so what's a bigger threat to you? The idea of stress in a financial system that, based on these results, might be pressured. I don't know about stressed or a credit crunch or some of these other descriptions. But on the flip side, you have a Federal Reserve that might be willing to go in a little bit more gangbusters with respect to rate hikes if there isn't that credit stress that restricts borrowing.
Yeah, so I think it's these things manifesting elsewhere in the economy. People are always very happy to look at these things as an idiosyncratic ring-fence event. This is something that's really affected these smaller banks and the ways the balance sheet has been managed. Our view is that this is actually symptomatic of such a rapid rate tightening cycle, and we're going to see these things spill out into the real economy, into the credit complex, into the equity world more broadly. A slowdown in the economy that's going to drag earnings down, and it's going to create a more volatile, bearish narrative for equities.
Greg, this was great. As always, to catch up with you, sir. Sticking with that 3,400 on the S&P 500 year-end. Greg Bowdle there of BNP Paribas. Something has to give, seems to be the take for a lot of people, regardless of your view on the equity market. The S&P 500 north of 4,000, at least a CPI with a 5 handle still, and we're pricing in a bunch of rate cuts. Can those three things continue, persist? I think there's a bit of tension at the moment.
And even people on both sides of the debate say that the market's mispricing what that risk is because it's binary, right? We either go into some sort of recession and that really does send inflation lower and crater the economy, or on the flip side, things keep going along, chugging along, and the market's just totally off with this rate cut expectation.
I'm going to go away from the macro. I'm glad you brought up M&T Bank. They're considered to be one of the best banks in the country. Their price to book in 5 years, John, has gone from a peak of 1.80 price to book, phenomenal price to book, to 0.84. I did not know that. That's just absolutely stunning to see a bank of that prestige in these times. And that's where you get these two markets of a huge amount of the market really underperforming.
Yeah, I don't think many people are familiar with that name, Tom, outside of the United States.
That's true.
Historically,
Absolutely.
incredibly well-run financial institution on the
Mr.
East
Wilmers.
Coast. I think headquartered in Buffalo, right?
Yeah,
Buffalo,
in
New York.
Buffalo,
Yeah.
the ex-Marine Midland and a merger up. And guess what? Mr. Wilmers used to listen to you and me.
Very cool.
He was very supportive.
The stock is positive in the pre-market. Coming up in the next hour, 7 a.m. Eastern time. So about 50 minutes from now, we'll catch up with Binky Charter of Deutsche Bank. Equity futures on the S&P 500 this morning, just about unchanged.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Gunfire and explosion rocked the Sudanese capital for a third day as diplomats intensified efforts to stop clashes between the army and a parliamentary group from escalating into a full-blown civil war. A long simmering dispute erupted this past weekend into a battle for control of the nation. Nearly 100 people are reported to have been killed. Tensions over China will be as high on the agenda as top diplomats from Group of 7 nations meet over the next 2 days in Japan. A senior State Department official says a focus will be on geopolitical challenges in Asia now that Japan holds a rotating G7 presidency. The meeting comes ahead of President Biden and other leaders going to Hiroshima for the annual Leaders Summit. President Emmanuel Macron has enacted his controversial pension reform after clearing a constitutional hurdle. The move was made possible after France's Constitutional Council approved the core elements of the bill on Friday, despite weeks of protests across the country. The law, which increases the minimum retirement age by 2 years to 64, will take effect in September. Sega has offered to buy Rovio Entertainment in a deal that values the creator of Angry Birds at about 706 million euros. The Finnish company's board has unanimously recommended shareholders accept the offer, which is backed by 49% of shareholders. Japan's Sega is doubling down on console and smartphone gaming as it seeks new ways to grow. And another sign of mounting pressure on the banking industry, Barclays is responding to a slowdown in deal-making and capital markets businesses by cutting about 100 roles in its investment banking group. The London-based lender already let go of roughly 200 positions from the same division in November. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
already saw some tightening of lending standards in the banking system prior to that episode, and there may be some more to come. And that does tend to lead to somewhat greater restriction in credit that could be a substitute for further interest rate hikes that the Fed needs to make.
Janet Yellen, the former Fed chair, sounding like the Fed chair, U.S. Treasury Secretary, speaking with
really well said.
CNN over the weekend. I think verbatim, that was straight out of the book of Chairman Powell and recent communication.
Stop the show. This is really an important observation you made, John, in that I think she's had huge difficulty transferring to the language of a traditional Secretary of Treasury. That may have been what the president wanted, but you are dead on that X number of quarters into this job, she still sounds like a central banker, which is okay. When you're a first-class economist, which everyone agrees, that's what you get.
I was reading through the transcript of that interview, and her outlook hasn't changed too much. I'm not seeing anything at this time that is dramatic enough or significant enough, in my view, to significantly change the outlook. Okay, your equity market on the S&P 500 right now, just about unchanged. Futures not doing much. Yields a little bit higher by a couple of basis points, just north of 350, but not really breaking any levels that we've not seen for a long time. In the FX market, we did do that on euro dollar on Friday's session, north of 110. Negative this morning, down about 0.1%, 109.75. Just want to get to one single name. Came out about 5 minutes ago. M&T Bank, the stock is positive, Tom, by 1.9%. Lisa went through the numbers. So provisions a little bit higher than expected for credit losses, deposits a little bit lower than expected, but nothing big here. And I think that's what's really come out in the last week or so. Some signs of stabilization elsewhere, encouraging a lot of people. Now, it's early days, and I have to stress it's early days. You will get a lot of regional banks, Tom, reporting later this week.
This is early days. It was, you mentioned before the break, the price to book is cratered off of the joy of 4 or 5 years ago. Their 10-year total return is sub 5% per year. This is one of the better banks, and the return's not acceptable. Imagine what we're going to see from the other banks.
Get Schwab a little bit later on today, Tom, then on to tomorrow. Goldman Sachs, Bank of America, some of the bigger players. Morgan Stanley on Wednesday.
Yeah, Morgan Stanley will be interesting. Srinath Rajan with that article out today on Mr. Saperstein as well. We'll talk about that later. Right now, a brief, and this comes off the IMF World Bank meetings, and thank you to all in Washington that helped us, particularly Peggy Noonan running the ship for us in Washington. Julie Norman joins now, co-director of UCL Center in U.S. Politics. Julie, is a broad stance. What I noticed at the IMF World Bank meetings were the unspoken. Nobody wanted to say China. That word was banned from the meeting. You couldn't say China. But the other thing that was banned was the word allies. Recalibrate for us now the Western allies. How allied are the allies?
Well, Tom, I think you mentioned China as well. And obviously, we've seen in the last couple of weeks, and I would say even longer than that, a little bit of wobbling in what alliance means and how different partners approach the question of China in particular. So obviously, we see strong alliances in terms of the stance towards Ukraine. We've seen that with NATO, with European partners. But with an issue like China, it gets a little bit different. There's a lot of different interests at play, as you all well know. And so I think we still see alliances, but at the same time, we see some differences among that as well. And so there's a little bit more caution in using that term when you're talking about some of these more complicated issues.
The bilateralness, or I should say the tension between Washington and Beijing, to me, is just too simplistic. Who are you watching among our allies to change the dynamic between Washington and Beijing?
Well, I think there's obviously the look to Europe first and foremost. The UK, I would say, has already shifted its policy, notably in the last few years. I think even more so because of China's actions against Hong Kong more than anything else. We started seeing a bit of a tilt in some of the UK policies, continental Europe otherwise. But I'm actually watching some other allies kind of outside of Western Europe, India in particular, states that are kind of in this kind of still allies with the U.S., but a lot of different kind of interests going on that do have a big say and influence on what's happening in the Pacific, in Asia, and in other parts of the world. You know, China, it's we think of this bilateral relationship with Washington, but so much of where their power is outside of Europe. It's in Africa, it's in Southern Asia, it's across the world, and so those are the countries I'm looking at.
Well, but Julie, taking a step back, one thing that really emerged from last week's IMF meetings was a sense of not only fragmentation, but an inability to have leadership to address it, to come up with what the framework is in the modern bipolar or multipolar era. Larry Summers, a former Treasury Secretary, on Friday said there's growing acceptance of fragmentation, and maybe even more troubling, I think there's a growing sense that ours may not be the best fragment to be associated with. China gives you an airport, we give you a lecture. How much is that really your sense of what's going on?
Well, I think you said it exactly right there. There's a lot of states that are finding it advantageous to partner with China because they see it as there's not strings attached. There isn't going to be pressure on democracy. There isn't going to be pressure on human rights. It's very transactional. It's very much a business deal. And so that works for, again, a lot of states, and it works very well for China. So I would say in terms of Summers' comments, again, there's a lot at play here. Again, the U.S. is still trading at its highest levels ever with China as well. So it's not like the U.S. is backing away from that, but the U.S. is coupling that again with very strong, arms buildup, with this very strong confrontational stance as well, that other states are hesitant to get onto that for their own interests.
Just getting a couple of headlines. Top diplomats in the G7 meeting over in Japan over the next 2 days. Here are the headlines from one U.S. official. G7 ministers agree on engagement with China, agreed to stay tightly coordinated on Ukraine, and then linking the two issues. G7 cooperation on Ukraine, Tom, leads to unity on China. The latest headlines from a US official as top diplomats meet over in Japan.
Seem to be massaged. I mean, it's exactly, I think it's exactly what you'd expect to see. What's important there is it's not a G8. Russia used to be in the club, and Russia's not in the club anymore.
Well, also, they've got to massage some of the issues of the last week. We keep returning to those comments, Tom, from the French leader a couple of weekends ago.
Oh, yeah. There is some
massaging to do.
Yeah,
is it fair
no
to
question.
say?
It's just ignoring. I mean, that's what happened with European officials. Just like, la, 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 we're totally united. That's
what I got from the IMF World Bank meetings too. Lisa, I'm so pleased you went there. Didn't you get that feeling as well? Just sort of hoping those comments didn't happen, pretending they didn't happen?
Totally.
I mean, you guys, I had to leave late because of this wonderful panel I did at the IMF. And of course, I stopped up on U Street at Ben's Chili Bowl. And I can tell you from reporting, they're still called French fries.
Is that the latest?
The latest. They didn't take
the diplomatic spat hasn't gone that
yeah,
far.
They didn't change. It's still French. Why don't you continue?
I plan to. Julie, I wanted to bring that up. When you listen to US and European officials, they're almost pretending this tension between the two does not exist. Julie, how much tension is there right now over trade, over big foreign policy issues?
Yeah, I mean, obviously there are tensions. I would say I don't want to overstate them either. I mean, right now, the most immediate issue is Ukraine. And I think the U.S., France, and other NATO countries are, that is where the alliance needs to stay tight, and it has stayed tight. China has always been complicated. There has been a difference between European and U.S. approaches to China for some years now. So this isn't really taking anyone by surprise. And even Macron's comments, I think, are a bit more probably shared by some others, even though people are pretty quick to critique him. But I think a lot of European states, as well as, again, other states on the periphery, are just realistic about the fact that China's going to take a little bit of a more nuanced kind of approach from many states where their interests are very intertwined there. And that's just a reality.
Julie, thanks for the perspective and the reality check, as always. Julie Norman there of the UCL Centre on US Politics. Just to recap some of those headlines from a US official following meetings that will continue over in Japan between top diplomats in the G7. Lisa, G7 ministers agree on engagement with China, agreed to stay tightly coordinated on Ukraine. They link the two issues. Cooperation on Ukraine leads to unity on China.
These platitudes really don't give justice to what's going on under the surface and the tensions that people are not talking about. What I got from last week's meetings was that somebody in the room needs to talk about the tensions, needs to hash it out, and needs to have some sort of leadership, because otherwise you're going to have the fragmentation under a mantle of unity that will eventually end up with incredibly a broken kind of system. We talk about Emmanuel Macron as being an outlier. He is not. He represents, frankly, what we're hearing from every single business executive that has a major business in China, whether it's Apple or whether it's Mercedes-Benz. And this really is one of the ultimate questions.
I think someone wrote in Barron's over the weekend that Macron was tied to Arnault by an Hermes scarf, and both were in the same situation with regards to China.
It's the same story. This is a corporate interest.
Didn't you say that they need marriage therapy? Wasn't that your line last week?
Whatever. Yeah, it's like you need
These
to hash
officials
out.
needed marriage
Well,
therapy.
they need to really work out the tensions under the room. Otherwise, it's just going to be a massive fissure.
There's marriage therapy. Thank you for that.
Live from New York City, welcome back to work, welcome to the program. This is Bloomberg Surveillance. Equity futures look a little something like this on the S&P 500. Futures positive by 0.05%. The S&P up last week by about 0.8%, squeezing out a week of gains. On the Nasdaq, pretty much unchanged last week and pretty much unchanged this morning. We're down by not even 0.1% on the Nasdaq 100. In the bond market, what a close to last week. Governor Waller. Closing out the Fed speak sounding exceptionally hawkish. Yields up. Yields higher again this morning by 4 basis points, 4.1393 on a 2-year this morning. Up a couple of basis points on a 10-year, Tom, to 353.18.
In 2-10 spreads, you got to make note of this. 61 basis points. We're not going to do technicals here on a Monday, but the answer is whatever the trend is, you're either near support or resistance. In this case, the 2-10 spread, John, is really buttressed up against support where it could break through to a greater inversion.
Let's talk about a level we did break on Friday. Euro dollar, a new intraday high for the year. On Friday, your intraday high for the year is now 110.76. This morning, 109.81 on euro dollar, down about 0.1% on that currency pair. Jordan Rochester over at Nomura, long the euro, and writing the following. Most of our forward-looking indicators suggest a high euro dollar ahead. We remain comfortable holding with the view that euro in Q2 will likely achieve new highs for the year, with 111 towards 114 in prospect. This is why we raise our conviction to 4 out of 5 in long euro dollar. So over at Nomura, Tom, you're familiar with this, but they have their calls on a range of currency pairs, and then they give you a conviction rating out of 5. This one's 4 out of 5, long euro.
Yeah, it's interesting to see. Joining us now, Jordan Rochester, G10 FX strategist at Nomura for a morning brief for Global Wall Street. Jordan, what I find interesting is if I triangulate and go to euro-yen, I've got euro-yen buttressed up against resistance at a 147. It's unimaginable strong euro, weak yen. On the U.S. dollar pair, is it about strong euro, or is in the zeitgeist this weekend, is it about weak dollar?
It's been a bit of both, Tom. I mean, I think in the past few weeks, it's been the dollar side that has really moved the needle for euro dollar. With the banking situation, SVB's collapse, it's allowed markets to price in the idea of Fed cuts. And a lot of people would argue too many Fed cuts are priced in. The irony is there are these cuts priced in, and I don't see anyone arguing for them to be priced in that way. So there is a bit of a dislocation between narratives and actual market pricing. But Tom, I think the good news for euro isn't over. I think the growth pickup that we've seen in the first quarter of this year should carry on into the second quarter. That should keep the ECB in a more hawkish footing. The market is pricing very much a too low terminal rate in our view for the ECB. So we look for 4.25% by July. The market's somewhere around 3.6. Now for the Fed, they could do a rate hike of 25 basis points in May. Our economics team thinks they won't. They think they are done with this rate hike cycle after the banking situation. But the market's pricing 21 basis points or so for that meeting. So if the Fed do go ahead and do a 25, I don't see much upside for the dollar from that rate hike. Where with the ECB, the market's not pricing the 50 basis points that we expect to see from them the next meeting. So from a monetary policy point of view and from a growth point of view, there's more upside, 114 in euro in the next 3 months.
Jordan, you sound like Christine Lagarde, optimistic over the weekend, speaking to CBS. Now, Jordan, I just wonder if there's anything to be optimistic about. Is this 425 on rates at the ECB because growth can handle it, or growth is really outperforming?
Well, last year was pretty doom and gloom. One of the best trades we had was just being short Eurodollar, short cable from pretty much January, February time onwards, especially when Ukraine was invaded by Russia. This year, it has been super different. It's been all of those negatives of last year turned around from headwinds into tailwinds. So last year was about very high energy prices weighing on the consumer, weighing on the government spending situation as well as corporates. Now energy prices have pretty much collapsed in terms of natural gas. They've gone below where they were before Ukraine was invaded too. This is a huge sort of disposable income boost for consumers and for firms as well, reducing their costs. So that from that side of things, the terms of trade for euro would put euro dollar between 115 and 120. Massive good news. But for the euro area and the monetary policy side, we've got all the inflation from last year feeding through to second round effects. Very tight labor market. We're seeing wage hikes coming through. We're seeing strike action in France as well. These sort of stories in the labor market will keep the ECB in a hawkish setting until it becomes very clear that inflation is going towards 2%. Where in the US, the Fed's more of a dovish setting now because the banking crisis has seen credit conditions tighten for firms. And we're already seeing the forward-looking indicators suggest that disinflation pressures are on the way. And last week's CPI, not coming in too hot, allows the market to carry on looking at those forward-looking signals of inflation. Because, John, the key difference for me is that the Fed is perhaps going to turn from looking just at realized inflation to maybe considering forecast of inflation when it comes to their policy settings. The ECB, they're not yet at that stage. They're a few months behind. That's why we think they'll keep raising rates through to July.
So this is a conversation about the cycle. Now, Jordan, you know how this works. Euro dollar goes from parity to 110. You get a 10% move, and you see those doom and gloom articles about the end of the US dollar circulating everywhere. Can we talk about the structural shifts that you're expecting from the greenback, Jordan, and whether you subscribe to this theory that you are going to see this structural shift away from the US dollar?
The digitalization of trade is helping, for example, China's role in SWIFT payments increase. The actual choice of currency in the past was tied to ease of use, and that was one of the factors behind it. And now there's an ease of use of just using any currency. So there is a structural tailwind for alternatives to the dollar. But there's also that when there's a crisis, you need dollars. That's still going to be the case for a quite long time. Trusting those other currencies to hold their value will be difficult in times of stress, especially if it was a Eurozone-related crisis or if it was elsewhere in the EM that we had an alternative crisis. High levels of inflation in that other choice of currency would erode the value of that. So it's not a perfect world for alternatives for the dollar when it comes to global trade, when it comes to just getting things, cross-border payments done. So, John, in essence, there are definitely shifting tides, helping alternatives to become more of an option. But I do think that the dollar is going to remain the majority reserve currency for probably the rest of our lifetimes.
Jordan, I want to go back to something that you said, which is the banking crisis in the U.S. will keep lending conditions tighter, which will really cap how far the Fed can raise rates, and talking about how that could potentially pressure the dollar, even if it's not a long-term kind of structural shift, as you were just talking about with John. Let's say there is no banking crisis. The M&T results that we got this morning seem to suggest that it's not really a problem, that all of a sudden, do you start to price in more Fed rate hikes, and you end up with perhaps a stronger dollar than you'd otherwise assume?
The biggest risk to the trade we have, Lisa. That's it. That is the biggest risk. If the banking data massively improves, all of the doom and gloom goes away. And let's say it's followed by an inflation print or two that comes in hot. Let's say shelter doesn't cool down. Let's say goods prices rebound. Then absolutely the dollar strengthens in that scenario. The H8 data, this gets released every week. The update from Friday showed that actually we didn't have consumer credit tighten as much as the previous 2 weeks. So we'll have to keep an eye on that data. If it massively rebounds, which would be completely shocking and weird, but if it was to do that, then you could definitely see the Fed carry on hiking, perhaps not at the 50 basis points clips that we saw last year. Maybe it's just the 25s until something else breaks, because it seems that when you get to these levels of rates, something does break. We've seen it already in the banking sector. The question will be what else? Is it commercial real estate and or other factors to consider? So yes, that is the biggest risk to the trade. Oil prices is the other one. So if oil rebounds, gets to $90, $100 a barrel, inflation rebounds, and therefore the Fed continues to remain hawkish. So yes, rebound in banking data and energy prices, two main risks to this long euro-dollar view.
Which also raises this issue of positioning, right, and how fragile positioning is at a time of great uncertainty. We've seen incredible whipsaws in benchmark rates, which should be a ballast for markets of stability. How tenuous is positioning that could create some really big moves in currencies, in currency pairs, given some of these big risks?
So positioning data is clear that essentially folks are on board with the short dollar trade. The euro seems to be where the consensus has built up, given all of the bad news from last year has turned into good news this year in terms of trade up. So the question is, if credit conditions tighten, can the euro really rally? And we saw that with SVB. When we had the financial conditions tighten, euro dollar did come off that day, and then it spread through to Credit Suisse. I actually thought it was remarkable how it didn't go much lower during that period of crisis. So the positioning is one thing in FX. Yes, it's long euro. But I do think about last year. Most of last year, real money managers divested away from European stocks because of the recession, because of Ukraine and Russia, because of higher energy prices. Now we're seeing continued inflows into the euro area, a rebalancing away from US equities towards European. And that's a structural trade as well. We've had underweights in European equities amongst investors for pretty much 10 years. All of the growth was in technology stocks in the US. That's now changed. So I think that it's on the FX futures side, it suggests long euro is in vogue, but I'm still seeing 5 months of continued equity inflows into euro area. So I don't think investors are overly net long euro to make a big risk for this trade right now, because I'm also looking at it from a terms of trade perspective and from the China reopening perspective too. So China's data has all come in quite pretty strong. China data surprises are at the highs, and Europe is 3 times more exposed to trade with China than the US. So all of those factors make it very difficult for positioning to be the big concern for me right now.
Hey, Jordan, thank you, mate. And congratulations over the weekend to Villa. Thank you, sir. Jordan Rochester of Nomura. Aston Villa getting it done over the weekend for good reason, because you guys are not getting it done at all. Someone sent me a message abusing Spurs on Twitter over the weekend. I had to write back. Guys, don't get confused. I know that he mentions the team a lot. It's nothing to do with me. Nothing to do with me.
I'm watching Ted Lasso, and they got the guy. Are those the real guys that do sports commentary?
I haven't seen season 3 yet.
They have the 3 old guys on the desk, like in London, and they must be the real people that do Premier League.
They probably are.
And all I could think of them is, I can't imagine what they were like yesterday. Is the Bournemouth? I can't even pronounce it right. The Bournemouth Cherries did it to the Tots.
They got it done. Comeback.
Unbelievable.
This is what Antonio Conte was so unhappy about. They can't hold on to a lead.
I can't
There's no
provide
discipline.
wisdom. My
they
answer
can't
is
suffer.
their defense just
Buckles.
it's not there.
Buckles.
It's not there.
We call it Spursy.
I don't
Things
know.
that just get a little bit Spursy.
And it's good to see Aston Villa. It's fun, isn't it? I mean, can Liverpool come back? Or are they like out of it now?
They need to try and get top 4, but it's going to be
Top 4 is
difficult.
the goal.
It's going to be difficult to get top 4. It's going to be hard
Man,
unless Newcastle collapses.
The way the Tots are going, they could look at relegation.
I think we're done with football now.
Oh, we
Equity
are?
futures unchanged
Very
on the
done.
S&P 500. The number one risk to that currency pair, euro-dollar. I'm so pleased that Lisa went there. What if we do get the all clear on the financial side of things and you go back to discussing more rate hikes, Lisa? And I don't think we're there yet. I think the outstanding question still remains: to what degree, to what extent are the events over the last month a substitute for rate hikes going forward? And I'm not sure we know the answer to that just yet.
I also think there's an issue of, have stocks maybe moved on from the banking crisis and bonds haven't yet? And how does that get resolved?
Well, I think that markets will move on more quickly than policymakers. Policymakers will be slower.
That's fair.
Simon French, Chief Economist at Panmure Gordon, joins us next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Delaware judge overseeing a voting machine company's $1.6 billion defamation lawsuit against Fox News has announced a one-day delay in the start of the trial. Jury selection and opening statements had been set for today. The case centers on whether Fox defamed Dominion voting systems by spreading false claims that the company rigged the 2020 presidential election. Japanese Prime Minister Fumio Kishida resumed election campaigning over the weekend after a smoke bomb was allegedly thrown at an event he attended in central Japan. Kishida was evacuated unharmed from the site, and a 24-year-old man is said to have been arrested. Now, that attack comes just weeks before Kishida is set to host a group of 7 world leaders for a summit. UK Prime Minister Rishi Sunak is expected to receive a boost this week as inflation slips back into single digits. Now it's raising hopes that the quickest series of interest rate increases in 3 decades is nearing an end. Figures this week are expected to show inflation dipping below 10% for the first time since August and a cooling in the labor market. And Merck is to buy biotech company Prometheus Biosciences for about $10.8 billion. The agreed price is a 75% premium to the target's closing price on Friday. Merck is looking to bolster its research pipeline and strengthen its portfolio of autoimmune drugs as it faces losing a key patent later this decade. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Whether you measure inflation using CPI or the Fed's preferred measure, personal consumption expenditures, or PCE, it is still much too high, and so my job is not done. I interpret these data as indicating that we haven't made much progress on our inflation goal.
Pretty punchy stuff from Governor Waller of the Federal Reserve. I believe there is still more work to do, seems to be the message. That was the message on Friday, and that delivered a lift at the front end of the yield curve. Yields higher. Here's a snapshot of things right now on the equity market. S&P 500 futures positive by, let's call it 3 points on the S&P. We are higher by not even 0.1%, up 0.07% this morning on the S&P 500. Yields up a couple of basis points on a 10-year, 350, 356. We talked about the euro against the dollar with Nomura. Jordan Rochester just moments ago talking up the prospect of going through 111, maybe out to 114 with some conviction around that call as well. On Friday's session, just short of 111. Right now, Tom, 109.85.
And the prices are there, and Bramwell knows this, John. She's way more up to speed on it than we are. LVMH moments ago announces they're going to do some form of bond deal. They've got 9.4% weighting in bonds. And, John, you know this. Every time you and I go into Tiffany's, our wallet gets lightened. Well, if you're a bondholder of Tiffany, you've enjoyed a price on the 44 with a 3% plus yield. Lisa, 148 to 93. I think that's a bear market in bonds, isn't it?
Are you basically implying that I know about LVMH's bonds because I am a proprietor?
I think, but what you know and what you've emphasized is we're going to see a bond frenzy. Every CFO out there is going to go load the boat.
Okay, there's this issue. Do you lock in rates here with the expectation that they could potentially rise further, or do you not? And actually, do you end up with corporate executives and CFOs siding with the bond market, which suggests that perhaps there could be lower yields going forward if you end up with some sort of recession? This is sort of the tension point at a time when you've got the likes of LVMH that maybe could lock in a better rate because they are crushing it.
Yeah, I think we need to be very careful with LVMH. Unique beast at the moment.
Yeah.
Very infrequent visitor to the bond market. I don't believe has come to the credit market since spring of 2020. And it came to the credit market in spring of 2020 for very, very good reason. There was a takeover of Tiffany's at the time and a lot of back and forth with the company too. So really strong fundamentals for the company. Tremendous profits announced in the last week. Put on top of that, the fact that they don't come to the bond market very often, I'm not sure the yield that LVMH will offer is really a great example of the broader credit market right now, Lisa.
Fair.
I think that that's absolutely correct. And there's an increasing bifurcation where the market is essentially closed for certain lower rated issuers. So this is a really difficult moment where the haves can keep getting and the have-nots are going to keep losing. And that's what we're seeing kind of borne out both when it comes to Wall Street and Main Street, as well as when it comes to the corporate America.
It's going to be interesting to see, to say the least. Right now, we're going to stay on the clarity of economics that helps people make decisions on bonds, on equity issuance. Simon French is with us, Chief Economist Panmure Gordon. And Simon, I want to go to just an absolutely scathing part of your latest note. I really don't know how to translate it. It is lost in translation for me, so help me. On the Bank of England, how did they get it so wrong? I mean, I'm fascinated by that. What did they absolutely screw up in the challenges post-pandemic?
Yeah, good morning, Tom. And I'm still reeling from the idea of you and Jonathan going shopping in Tiffany's, so I'm going to have to try and take that. I'm going to have to take the answer
Simon,
on the Bank of England.
we buy each other gifts, just to be clear about this. We exchange gifts.
Okay.
Just little charms for our bracelets.
Are you talking about us or you and Simon?
No, me and TK.
Oh, God. Please carry on.
Let me bring it back to Tom's question.
Thank you.
As tempting as it is to take that diversion. So, look, there were events in both energy markets and capital markets which central banks, particularly in Europe, so we think of the Bank of England and the ECB, were slaves to in Q4 of last year. The shape of the European gas energy curve, the shape of the credit curve, financial conditions. But, and this is where the Bank of England, I believe, made the wrong judgment. They made the wrong judgment regarding the resilience of the labour market at a time when there were record vacancies, record demand across the UK economy. But also they made the wrong judgment on precautionary saving. And we've heard a lot about this story in almost every jurisdiction, the fact that there was a lot of pandemic savings that took place that were accrued and they haven't yet been divested, particularly in Europe, particularly in the UK. It's a different story story in the US. And that judgment that we were going to see households accrue more as precautionary savings rather than divest, I felt was a misreading of the 2 years that preceded this period.
Where are we forward now? I mean, what is the central bank confidence in their belief forward coming out of IMF World Bank meetings?
Well, when it comes to the Bank of England, and your specific question was around the bank, there is an upgrade coming. So they convene again at the start of May with their quarterly monetary policy report, and they're going to have to reverse from what they perceived back in November of last year, a very opinion-framing forecast of an 8-quarter recession, the longest in 100 years. When I speak to international investors looking at UK macro, that narrative really framed expectations for 2023. We're going to see the reverse ferret, not to a position of runaway economic growth and big divestment from households, but certainly where a technical recession is avoided and you get a considerable growth upgrade. In the context, however, of still all the challenges that the IMF laid to bear in terms of the structural challenges, low productivity in the UK economy, the ongoing challenges of Brexit. But compared to where we were last November, it's a world away.
Simon, are you concerned that the economic models that we have followed for the past number of decades have kind of been thrown out with this increasing fragmentation in a way that perhaps people weren't talking honestly about last week, at least when it comes to the official discussions at the IMF?
I think it's an excellent point, Lisa, and the privilege of coming on this show over a number of years is we've talked about the failure of those models in two very different parts of the cycle, during a lower forever stagflationary or stagnation environment. Now in a stagflationary environment, those models aren't necessarily doing much better. What I think you're alluding to, and I think correctly so, is the IMF talking in a much reported blog on that reversal to the structural low interest rate environment due to the demographic impacts, high debt burden impacts on keeping the natural rate low. But I felt there was another part of that blog that got not nearly enough coverage, and this speaks to your question, which is choices over protectionism in global trade, choices over the transition, the energy transition towards net zero, are going to radically dictate or materially dictate that interest rate path. So the fact that the reporting was that the IMF think there's going to be a fait accompli, we return to low interest rates, I think was a misreading of what I thought was actually quite a thoughtful blog post.
Do you think that there is a political element that is kind of making it difficult to have leadership in this that has economic ramifications if you have leaders that are unwilling to price in a new reality that really does account for what you're talking about and really does affect where we're going to be when it comes to the inflation levels that we study out to?
I think you are right. I think politicians over the last 12, 13 years have become, as it has to be said also the corporate environment have done, they've become quite comfortable with refinancing and progressively refinancing at ever lower nominal and real interest rates. And of course, if you start to acknowledge in your forecasting models, in your long-term planning, that may not be the path, then the amount that you can give away on current spending, the amount you can backstop public sector investment has to be reduced. Those are tough fiscal decisions. They are tough fiscal decisions outside the electoral cycle, and both sides of the Atlantic, we've got some quite key elections coming up over the next 18 months. So that reality, or that embracing of reality of a very different path for the natural rate is not going to come easily.
Simon, wonderful as always to get your perspective. Simon French there of Panmure Gordon. I'm actually with Simon on that blog post of the last week or so. If you do read through it, there is this line in there, and I'm going to paraphrase. It sounds something like, our projections are only as dependent as the projections that underpin them. And that's when they start to talk about deglobalization and some of their underlying assumptions around that theme, but acknowledging that that could be a contributing factor to higher real yields going forward.
And the chances of that are not insignificant. And I think that's really the sort of dispersion of potential outcomes is what you're feeling underpinning some of the tensions in the market right now, why people are pricing in rate cuts at a time when the economy still looks strong.
Just away from rates for a moment, could I just jump in?
Please,
there was a report from the FT on the Bank of England that's worth discussing as well about changing the deposit guarantee scheme. So in America, it's 250,000. I'm not sure how many people are aware of this, but in the UK, Tom, only 85,000 sterling compared to the 250 limit.
Wow.
in the United States. So some reports from the Financial Times, they might be reconsidering that number, TK.
I want to drop in this morning your experience so far in Brexit, because you lived it. I mean, John lived it more than anyone at Bloomberg that morning.
Because I also Brexited that month as well, Tom.
You Brexited that month. I was breakfasting while you were Brexiting.
I'm aware. I'm well aware.
The banking crisis is a crisis of the banking system. This was a banking tremor.
The worries about the large banks is over. They're resilient.
It looks now like we're certainly on the mend.
The last thing the Fed wants to do is suggest that their work is done when it may not yet be done.
Something's got to rebalance here, and it's the Fed rate hikes cooling the economy off.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Don't call it a banking crisis. Mohammed on Friday. It was so good, wasn't it? It was fantastic. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures just about positive, 0.1% on the S&P 500. More bank earnings this week, through the week. Goldman and Bank of America tomorrow. On to Morgan Stanley on Wednesday. A real regional flavour to the banking mix as well this week, Tom. And arguably that's where the attention will be and should be later this week.
And there's 8 flavors, particularly for our international audience. It's not just 4 big banks, super regionals, then this thing called regionals, and then itty-bitty 4,000 banks. There's all sorts of nuances in there that the banking pros, Ken Leon, Gerard Cassidy, the rest of them, they know all those. We're going to have to sort that out as we go through earnings season.
I think we're already sorting it out. The major banks on Friday reporting some stellar results.
JP Morgan was like, whoa.
And then the regionals, Tom. So M&T Bank this morning, East Coast Bank. A little bit later this week, banks like Western Alliance, West Coast Bank, California, Nevada,
with a
Arizona,
whole different
kind of
culture and auditing process. It'll be interesting to see some of the footnotes involved there.
And Lisa, what we've learned so far is that these big banks, these major financial institutions, Goldman, Wells, Citi, ports in a storm. Ports in a storm is one argument. Now we need to deal with the second argument, which is whether we really can say the coast is clear based on the data from Thursday, which is about borrowing data from the Federal Reserve, and the data from Friday, which is also from the Federal Reserve, but it's about bank lending data.
Okay, not to get too philosophical, but which coast, right? I mean, on one hand, we might not get a collapse of a big banking institution. We may not get a collapse of many smaller banking institutions, but you may see the ongoing grind and consequences of people moving their cash out of deposit accounts into something that actually delivers yield. And this, to me, is the bigger risk. Do people sound all clear at a time when you are seeing stability in the banking sector, especially among the well-run companies, but not necessarily counting for how much credit could tighten?
So that's a profits issue as well. And I actually think that JP Morgan did a decent job on the call. The CFO was talking about the flightiness potentially of some of the deposits they'd gained on the quarter, Tom, from some of the stress elsewhere. Act 1 is just worries about return of capital. You want your money back. You want to know it's there. So you get away from some of these regional banks. You go to somewhere where you know it will be. JP Morgan, Citi, wherever it might be. Act 2 is about return on capital, which I think is what basically JP Morgan is guiding towards. This money that's turned up, arrived in the first quarter, we think it might dance off elsewhere in the coming weeks and months.
We'll see this Monday, Tuesday, frankly, into all next week. It could go into May, but the answer is when do you catch up with 5%? And I would go almost to a retail, and it can be institutional as well. I'm old school. Ira Jersey says, I don't know. I'm in the Ira Jersey timeout chair on this. I just look at 3-month LIBOR. And it's not 5%, it's 5.26%, which is not towards 6%, but we've moved quickly on that old school benchmark. And it's like, when do they start paying people to give me your money? That's the heart of it.
It's been a major change over the last 12 months, that's for sure. Let's give you a snapshot of the price action. Lisa can give you a snapshot of the day ahead. The S&P 500 positive by a little more than 0.1%. Yields higher by a couple of basis points, 353.75. Seen a lot of price action on the euro against the dollar over the last week. 110.76, I think it was on Friday's session. Right now, this morning, Lisa, 109.84.
Looking forward, we did get M&T results earlier this morning in the smaller banking sector. We're getting Charles Schwab basically any time before market open. This really does kick off those earnings of smaller banks. U.S. Bancorp, Citizens Financial, among those that are going to be coming out. Look at the underperformance. Schwab shares down nearly 40% year to date. M&T down nearly 20%. A profitability issue. How much do the latest results really speak to the profitability of these companies, let alone just the fact that they're going to stick around and they're not in an existential crisis? Today, we also get a number of economic data points, including 8:30 a.m. Empire Manufacturing Survey. I'm very interested to see whether there was some sort of ongoing weakening in April. We also get the NAHB Housing Market Index at 10 a.m. If you take a look at the U.S. Financial Conditions Index, it actually has retraced about 80% of all of the tightening that we have seen since the SVB collapse. So again, what is this exactly putting into the market with respect to a restriction that can offset what the Fed has to do? And today, the central bank speak includes ECB President Christine Lagarde, as well as Bank of England Deputy Governor John Cunliffe and Richmond Fed President Thomas Barkin. Is there ongoing divergence from the ECB being hawkish and Federal Reserve, who are supposedly being more dovish, but not what we heard from Waller on Friday?
Lisa, thank you. Incredibly hawkish on Friday. Let's frame the debate in the equity market right now with a bull and a bear. Here's the bearish view. Mike Wilson, Morgan Stanley, kicking off the week. With the fastest Fed policy shift in 40 years, we think more negative surprises lie ahead for investors. He goes on to say, one that we think is in plain sight is earnings forecasts that remain too optimistic. That has been the message from Morgan Stanley for months now. Binky Chadha takes the other side. The chief global strategist and head of asset allocation at Deutsche Bank joins us right now. Binky, so let's start with this one. And good morning to you, sir. Thanks for being with us. Still long, still optimistic. What underpins that view for you?
So in the very near term, it's earnings. And I think, the things to keep in mind are, number one, the equity market almost always rallies during earnings season. It's not a huge rally. It's about 2.5%. But, that would put us, it would change the handle on the S&P to the mid 4,200s, closer to 4,300. I think on earnings, the big picture issue is very simple, which is that if you look at the top-down macro drivers, what we had is upgrades to growth in the U.S., in Europe, in China, in Japan. We had the dollar come down. All of that argues basically for, upside in or a rebound or a turn basically in earnings up. And if you look at the same time as what we are measuring earnings against, which is the bottom-up consensus, it's been falling since June of last year. It's down about 16, 17% now. And so when you take the top-down drivers and you plug them into our earnings models or frameworks, it's telling you we should get a pretty significant rebound in earnings. We should get a pretty average beat of about 5%. So there's this narrative out there that the bottom-up consensus is forecasting, the worst earnings season ever and down 7%. I mean, I think they should be a little bit careful with that hypothetical because the earnings beat almost always by 5%. So you're already down to sort of about 1.5%. And so if you get a little bit bigger beat, you saw the results on Friday, you're back at zero.
Okay, well, you get 20 stocks doing well. And the S&P has basically made it halfway back out of a grim bear market. Institutional portfolios maybe have made halfway back is a basic statement. And this is great, Binky Chadha, in that you take a longer timeline, a more relaxed view, and within that you talk about a passing of the baton from earnings to the next thing to keep your optimism going. What's after our earnings analysis?
Well, it will then depend basically on, the big cloud and whether it's going to erupt into a severe rainfall of the U.S. recession. And there, what I would say is that basically, instead of just looking at the aggregate all the time, we should do what we used to do when the pandemic began, which is differentiate goods and services. And what you will see here is a very, very clear picture. And what I would argue is that, now really comes the test. If you think about a trend line, we've got services that fell far below and have been rebounding and sort of, asymptoting, or the growth rate is slowing basically towards trend. And the important thing to keep in mind about services is they don't generally slow very much. You don't get really recessions in services. And all of the action has really been for the last 2 or 3 years on the good side, where we got massively elevated relative to trend, depending on what metric we're talking about, anywhere between 15 and 25% above trend levels. And it is something that we wrote about in the summer of 2021 called the COVID speed cycle. And since then, what has happened, I would argue, is an incredibly resilient outcome, which is we've been going sideways in real terms for 2 years. And the key question is, as we come back down to trend levels, which we are very near now, are we going to start growing or are we going to suddenly crash?
So as we talk about earnings season and the expectations are all over the place, you have a more bullish expectation, Mike Wilson, a more bearish one. The overlay of a banking crisis that wasn't, what are stocks currently pricing in, taking out some of the regional bank stocks? What are they pricing in with respect to contraction of credit?
I don't think that the equity market is pricing in that much in terms of a credit downturn. But, if you look sort of at what is the equity market pricing? It's pricing an ISM of 46, which is what we got. So it's kind of right where it should be in terms of the very short-term, near-term drivers. So nothing really more than that. And in terms of the banking stress, to the extent that it's already captured basically in the PMIs and the ISMs, then the market's priced it in. So something bigger, no. But
do you think it makes sense that we have basically an S&P 500 you anticipate will get to 4,300 and a rates market that is pricing in some serious rate cuts? Do you think that can persist?
So, on the rate cuts issue, what I would say, if we are talking about the 10-year yield, the difference of view between the Fed when you open its dot plot, the first thing that you see is the rates are coming down massively. So the question is really about 6 months over a 10-year period, 6 months, 8 months, maybe 9 months, but it's not a huge move. I think the bigger issue for rates really is, all of the forward guidance that convinced the market to go massively short kind of blew up. And so is the risk appetite to be just as short going to come back so quickly?
I just asked the question from an equity
skeptical.
perspective, Binky. I'm just wondering, does the S&P 500 at 4,300 and CPI at 5%, does that encourage the Federal Reserve to cut interest rates? I mean, I struggle with the logic.
No, it certainly doesn't. No, I mean, it's not our house view, but our house view is that we will cut interest rates next year. Yeah. So it's, again, I don't want to get overhung up on what is a very fluid calendar and precise calendar times, and then they're all out there in the future. So I'd be a bit careful on that.
Binky, thank you, sir. Binky Chowdhury of Deutsche Bank, constructive into earnings season, looking for potentially a move to 4,300. We've been in this trading range for months now, Tom. 3,800 to 4,200, and Binky's looking for a breakout of that range to the upside.
Binky Chowdhury, Deutsche Bank, John Stolvis Opco, Ben Laidler of eToro, and others. What's important here is they don't have a rigid timeline. They're looking at a framework, and somewhere out there, they get to that bull market scenario.
They are the optimists.
Yeah.
They are the optimists on the street. Coming up in the next hour, David Balin of Citi Global Wealth. Good. That conversation about 50 minutes away. Equity futures this morning positive by a little more than 0.1%. The bank earnings keep rolling in.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. SpaceX is set to launch its massive deep space rocket Starship into space this morning. If successful, the test flight will be a critical milestone in the company's ambitions for manned missions to Mars. NASA also plans to use the same spacecraft to return to the moon. Once operational, Starship will be the most powerful rocket ever built. Gunfire and explosions rocked the Sudanese capital for a third day as diplomats intensified efforts to stop clashes between the army and a paramilitary group from escalating into a full-blown civil war. A long-simmering dispute erupted this past weekend into a battle for control of the nation. Nearly 100 people are reported to have been killed. President Emmanuel Macron has enacted his controversial pension reform after clearing a constitutional hurdle. The move was made possible after France's Constitutional Council approved the core elements of the bill on Friday, despite weeks of protests across the country. The law, which increases the minimum retirement age by 2 years to 64, will take effect in September. ECB President Christine Lagarde says she doesn't foresee the U.S. defaulting on its debt. In an interview with CBS, Lagarde said she is confident the U.S. will not allow that to happen, saying it would have a negative impact globally. The Biden administration is locked at an impasse with Republicans over government borrowing and related spending cuts. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I have huge confidence in the United States. I just cannot believe that they would let such a major disaster happen of the United States defaulting on its debt. This is not possible. I cannot believe that it would happen. But if it did happen, it would have very, very negative impact, not just for this country, where confidence would be challenged, but around the world.
Almost unthinkable still for so many people. That was Christine Lagarde, the ECB president, on CBS over the weekend. Live from New York City this morning, back in New York, after some really interesting IMF World Bank spring meetings down in DC over the last week. We return to the price action in the equity market. Equity futures right now up a little more than 0.1%. Earnings a bit quiet today. We've had M&T Bank a little bit early this morning. At least we'll go through those numbers a little bit later. We'll get Schwab numbers a little bit later this morning. Then on to tomorrow, when we hear from some other big financial institutions as well, including Goldman and Bank of America. On to Wednesday, Morgan Stanley, and a lot of regional banks in the mix as well, Western Alliance being one of them that we'll hear from over the next couple of days. Outside of the equity market, yields are higher by 3 basis points on a 10-year, 354.32, 354.51. Just to sort that out as it moves in front of me. And in the FX market, euro-dollar just south of 110. We had a move, a break of 110 last week. 110.76 is your new intraday high for the euro against the dollar. Some real euro strength creeping in. Just a touch of euro weakness this morning, Tom. Net currency pair negative, a little more than 0.1%.
Something we don't talk about that much. 2021 on gold. Gold is elevated. I don't, like
just short of a record.
Just short of a record. And again, to this resistance support thing, does gold break through given the news flow and maybe a safe haven status as well? On a jumbled Monday morning, it is good to speak with Anne-Marie Horton. She was our hostess in Washington, did a wonderful job, our Bloomberg chief scandal crisis, massive story correspondent in Washington. Anne-Marie, I don't know where to begin this morning, but I think I've got to make clear the national shock that a 21-year-old could do all this damage. And like others on the Twitter sphere, I take issue with the word leak on theft of government secrets and all. What is next for this 21-year-old?
Well, there's a massive investigation going on right at the Department of Justice and, of course, at the Pentagon. And I think the next big question that's facing the government, there obviously will be hearings in Congress. You've heard over the weekend and all of last week, members of Congress coming out and wanting precise questions and answers about how this could happen with a 21-year-old. But potentially then this would lead to maybe new categorizations on how certain people have access to certain data. And that's a big question. Right. But at the moment, this is a huge investigation, and there's still more questions than answers.
What happens to him? I mean, is this like a John LeClaire novel where he goes away forever? I mean, I don't see enough written about what's going to actually happen in this alleged criminal event.
I don't think we know yet. Obviously, he was arraigned and arrested, and then he'll go on trial, right? And then a jury will decide.
There's also a question,
I imagine,
Emery, about the distribution of some of the information that was stolen, that was leaked. And there has been some connection to online Russian bloggers and online Russian personalities that have perpetuated and gone way below the radar of a lot of the intelligence. What do we know in terms of the proliferation of that type of disinformation?
Well, there's one interesting lead this morning in the Washington Post, which plays to this story, and a massive concern for the Pentagon and the national security establishment in Washington was any of this infiltrated or propagated by Russians. We do know that Russians do send out individuals, intel individuals, to places like this, to these gaming apps, etc. And in one of the leaks, the Russians were, in this document, were saying how only 1% of these quote-unquote hackers or influencers they send out are actually found by the U.S. government. So I think what you see here is potentially concern that there could be more of these individuals out there that the U.S. government doesn't even know about.
Meanwhile, just to shift gears a bit, we have that situation unfolding at the same time as ambassadors from the G7 nations are meeting in Tokyo ahead of the meetings there. And I'm wondering what you're looking for. You've been to meetings like this. You've seen the kind of communiques that have come out versus the scuttlebutt under the surface. How are the G7 nations coming together to deal with the threat of China, and why is it important that it's being held in Japan?
So I think what's interesting now is following on the heels of Emmanuel Macron's visit to China, I think what comes out of this G7 communique will speak volumes, of course, because remember, he said that he wants Europe to have its own autonomy. And what the United States is doing is complete opposite. They want a multilateral approach when it comes to China, whether that's export controls, whether they're looking at issues provisions when it comes to outbound investing, when it comes to making sure that there are shipments of arms to Taiwan. They want to make sure that they have all their ducks in the row with their European allies to combat China. Very different a bit from what we heard from Emmanuel Macron. So I think that's where we want to see where the consensus is and potentially where the U.S. still needs to do more work with its allies.
Anne-Marie, I believe Secretary of State Blinken was scheduled to go to China. It was canceled, etc. Do we still want to send him there? And do the Chinese still want to greet him?
Well, the U.S. State Department still plans on sending Secretary Blinken at some point. We also heard from Treasury Secretary Janet Yellen. She says at some point she's going to go. We heard from Commerce Secretary Gina Raimondo. She says she wants to go to China at some point. But none of these have been fully detailed in terms of the dates that we know that these individuals are set to go. Interesting, another, which, really the congruent of both these stories, the leak and China, is over the weekend, the Washington Post talked about that actually they found 4 other spy balloons, alleged Chinese spy balloons. So potentially there could be more headaches for the administration coming out of this leaks when it pertains to Beijing.
Anne-Marie, can we just finish on that? I've heard so much about the leaker over the weekend. The conversation that you were having just moments ago, didn't hear nearly enough about what was leaked over the last month or so. What have we learned about that in the last couple of days?
So over the weekend, there was that one story about more Chinese spy balloons, not just the one that many people saw with their naked eye over the continental United States. There's another story as well about concern the U.S. has about Taiwan being able to defend itself in an event of the Chinese army invading the island. So those are 2 big stories coming out of this leak, and obviously causing some concern. Not all of this is mind-blowing to a lot of people. They expect a lot of this to happen, but now you're seeing it in black and white. And now either the DOD or whether it's national security apparatus or the White House, they're going to have a lot of answers. They have to have a lot of answers to these questions.
There's some really sensitive issues there. Anne-Marie, thank you. AMH down in Washington. We'll catch up with Anne-Marie a little bit later this morning to break down some of these issues. Tom, I've not heard nearly enough on what was leaked, and I imagine we're still finding out.
I don't think they want to tell us is the thing. And, someone mentioned, Anne-Marie or Lisa, I believe, that there'll be a court case. Well, okay, what can you say in a public court of law about some of this sensitive stuff? I think that'll all come out. I take the point, was it a leak or did he just steal it and give it on to his friends as a high? I mean, I'm not qualified to answer that question.
Either way, one of the big debates is whether this is really an issue from an ally perspective, whether they're not going to necessarily give the U.S. the same level of information and trust, or whether there actually is a jeopardization of some of the tactical battles on the Ukraine's part, or what we know in terms of what's coming out. Also, what Anne-Marie was talking about there, reports that the U.S. had gauged that China absolutely could win out in airspace superiority when it comes to Taiwan, and what that implication would be. But they couldn't actually occupy the territory. These are all of the kinds of sensitive information that you don't want to be reading about, and yet here we are.
We'll stay on top of the story for you. The details still pouring out. The story only a week or so old, a couple of weeks old. The equity market shaping up as follows on the S&P 500, just about positive by 1/10%. We talked a lot about the earnings from the financials. In a moment, we'll talk about the bond market. Yields higher by a couple of basis points on a 10-year to 353.94. In just a moment, Tom, we'll catch up with Andrew Balls, the CIO of Global Fixed Income at Pimco, a timely conversation.
Well, it's going to be timely on a number of different levels, but to me, what it's really about is this bond issuance issue. What do corporations, what do sovereigns do worldwide here, given the shift to higher yields?
And we can't lose sight of the fact that we went from 0 to close to 5%.
Yeah, higher yields.
In 12 months. And that's arguably what was behind this massive profit story at these big banks. From New York City, this is Bloomberg. Brand new week on Wall Street following a week of gains. Your equity market shaping up as follows this Monday morning. Good morning to you. Equity futures positive, almost 1/10% on the S&P. Unchanged last week on the Nasdaq, unchanged this morning on the Nasdaq as well. The Nasdaq 100, negative 0.02%. That's nothing. Thanks, Lisa. In the bond market, let's get to Treasuries and see if we've got something for you. The 2-year, the 10-year, the 30-year. Yields a bit higher here across the curve. Led by a move at the front end again by 3 basis points on a 2-year, 4.13 to 9%. The move higher on Friday, really encouraged by the words of Governor Waller of the Federal Reserve. It sounded pretty hawkish. In fact, I would say very hawkish. With regards to what we've seen so far in the financial system, he's basically saying he hasn't seen enough improvement on inflation and they've got more work to do. More work to do. Does that mean more than 25 basis points, which is implied by the dot plot? I imagine Governor Waller's dot is somewhere else above the median dot in the SCP. We can talk about that later. Want to finish on foreign exchange, just the euro. Just seen some real euro strength over the last several weeks. That meant we saw 110.76 on euro dollar. Now we've backed away to about 109.75. On that currency pair, Lisa, negative a little more than 1/10%.
You talk about Governor Waller's comments, and I think that's a good place to start as we move into some of these single names, because he was talking about how perhaps the work isn't done. Does this mean rates that go higher or just stay high for longer at a time when you've got 3 full rate cuts being priced in by January of next year? How much does the banking crisis averted really go into that story of rates staying higher if there is no banking crisis? And what you see this morning is not a sign of a banking crisis. Perhaps stabilization is really the theme of the morning. M&T shares up more than 4% in pre-market trading after reporting basically in line with expectations. Their year-end deposits, $159 billion versus the estimate of $161 billion. So just slightly lower at the end of the period, at the end of the quarter. And the provisions for credit losses slightly above the estimate, but nothing significant. And that's the reason why you're seeing a pop. Operating earnings per share actually beat expectations. Schwab were expecting any minute to come out. Those shares up about 2% ahead of the market expectations. And this will be interesting, especially because they pioneered the zero rate brokerage fee kind of trading strategy. Does that end up coming to bite them in a way that it certainly did in March with their worst month since 1987? And Google, this is interesting to me because we talk all about the big tech numbers and how much they really are the behemoths and untouchable. How untouchable are they when you start talking about artificial intelligence and ChatGPT? There was a report over the weekend that said that Microsoft's Bing might replace Google as the default search on Samsung electronics devices. And there's a question around whether some of these other competitors could do it better and cheaper with a more updated version of artificial intelligence. So see, these are some of the moves, and you're seeing those shares down about 3% ahead of the market.
On the Android operating system on the Samsungs?
Correct.
Interesting.
And you're seeing that. I mean, Microsoft, the setting is Bing, right? Because that is theirs. And people don't even realize they're going to Bing. But if Bing actually ends up with a better...
Oh, they know they're going to Bing. Everyone knows they're going to Bing.
I'm not a big Binger. I like Googling better than Binging.
If anyone directs you to Bing, you know where you are.
I know.
You go straight to Google.
I do, but is that going to change if they have more sophisticated Binging technology?
This sounds like a conversation from 12 years ago.
Doesn't it?
It's just... The underestimation of Google's search power is something I think, Apple Safari's made some nice inroads here recently, but
Safari,
Bing,
I haven't heard that in a long time.
It's gotten better. Like Apple Maps are trying to fix it, but it's still not Google Maps. But Bing is Bing.
Bing AI? Is that different?
Bing GPT.
Okay, let's go back to rates and play it safe. Andrew Balls at Pimco has this to say on the economic outlook and the risk of a recession. I think a lot of you at home might share this view. Bank failures and rising cost of capital raise the prospect of a significant tightening of credit conditions, particularly in the US, and therefore the risk of a sooner and deeper recession. Tom, we've seen some signs of stabilization over the last week. That's clear. But still, I think this is a key risk for a lot of people.
It's a key risk, and one of the joys of Andrew Balls is he's one of the big thinkers out there who actually has been in the trenches of portfolio management. He took the Morningstar Trophy for Fixed Income Manager of the Year 8, 9, 10 years ago. So he's got a beautiful experience at dovetailing the investment world into that of the broader economics. Andrew, the credit conditions tightening, it's about inflation. Citigroup published moments ago that the German union sector in their renegotiations is going to have 12% wage growth in the next 24 months. That's a stunning number. Have we turned inflation around as we consider our credit conditions?
So I think it remains a big uncertainty. You know, as you say, that's an impressive number for German type wage agreements, but inflation has been very high there, almost as high in the US, and it's on a bit of a delay, a couple of months, couple of quarters behind the US. And I think the picture is that inflation is coming down across the world, driven by energy prices, and underlying inflation. You've got some evidence that it's starting to edge down. And the difficult thing is, where is it going to settle? And it seems pretty likely to us at Pimco that it will settle a little bit above the central bank target zone. And then, you know, how comfortable they will be is the big question. And then at the same time, you have improvement, as you were just talking, in terms of the US banking system, in terms of the financial market volatility, but still, we think there's going to be a big impact in terms of credit conditions. So tightening credit conditions, but still sticky inflation. It's a difficult combination for central banks in Europe or in the US to deal with.
Well, on nominal GDP, this to me is a really important point. Okay, so we get some kind of real GDP, and then the call is inflation comes in sooner, and Pimco saying in later. Is Pimco saying this is secular stagflation?
I've lost them.
I think we've got some technical problems there with Andrew. I was going to the two-part idea, guys, that the great debate is real GDP, whatever that's going to be, and then inflation in quickly or inflation not in quickly, which is clearly what we're hearing from Andrew. And that, to me, nudges towards summer secular stagflation versus just a lassitude, which was the worry of the IMF.
So the next question, TK, is how quickly do they ease? And you know how this works with financial markets. The Federal Reserve starts to suggest a pause in its outlook. And what does the market hear? The market hears easing and cuts. And that's the new tension. And it's not really that new, because it was the tension that we were talking about at the start of the year. And Lisa, we thought we resolved it with the market coming up towards the Fed, and then after the banking chaos of the last month, it opened back up against. And now the Federal Reserve is trying to communicate that we've got more work to do. Governor Waller Friday, others as well. And we're not going to be cutting this year. This is some tension that will resolve with time and data over the coming months.
Bonds seem to be pricing in some sort of more sustainable credit crunch or some sort of banking issues, whatever you want to call it, kerfunkel or tremor, however you phrase it. The bond market seems to be reflecting that. Stocks do not, apart from perhaps the KBW index. That tension needs to get resolved, because either the Fed has a much lower threshold for cutting rates, or else these issues are really going to be much more sustainable and impact the equity side of things.
Well, we framed it as follows. The S&P 500, Binky Charter, Deutsche Bank sat in that chair, said 4,300. 4,300 on the S&P, the CPI still at 5%, and the market pricing at a bunch of cuts. Something's got to give out of those three, right?
Right, which is really the issue that we continue to see, that people don't seem to be resolving, and we don't have a sense of what the actual situation is.
We had some technical issues with Andrew Balls at Pimco just moments ago. I'm happy to say we've resolved them. Andrew's back with us. Andrew, sorry about that. Our apologies. Let's go back to where we were, and we can build on what we were talking about around the desk here in New York. The tension again between the market pricing cuts and the Federal Reserve signalling a pause after one more rate hike. How do you and the team at Pimco expect that separation, that spread, so to speak, Andrew, at the moment to be resolved?
So it is tricky. I think the kind of pricing for equities, pricing for fixed income is a little bit confusing. I mean, I think the best way to think about it is the bond market, in terms of what we're pricing for Fed cuts, it's the average outcome. So you've got a good chance of the Fed being on hold for some time, given sticky inflation, elevated inflation. But then you also have the risk that the credit crunch gets a lot worse, and the Fed is cutting, really seriously, maybe even back down to 1% again. So you kind of average those out, and you across the scenarios you can explain what's being priced in. So maybe the equity market is priced more for the kind of the modal, most likely outcome, fixed income, a little bit more reflecting the mean outcome. This range of possibilities. I mean, a soft landing is certainly possible. It's not easy to do given where inflation is, but it's certainly possible. But our best guess is we will go into a recession in the US.
Andrew, this pains me to ask, but are bonds reliable? I mean, they used to be the smart guy in the room. Are they still, considering how much we've seen incredible volatility and, frankly, bonds being wrong?
Well, I think with changing information, you price this very quickly. I mean, I also think it's there are times when the outlook's very uncertain. I think if you're at the Federal Reserve, there's a great deal of uncertainty there. The bond market, trying to price the range of outcomes around this uncertainty. So we will see. I think it's perfectly likely that we will see the Fed on hold through the rest of this year. This is our expectation for our baseline, but there are the risk cases around that. And I think if the market prices out these Fed rate cuts, I don't think that needs to be too destabilizing. I mean, this would be confirmation of avoiding the worst kind of economic outcome. So that would be good news. So I think it's perfectly plausible. But I also think at the same time, credit markets, fixed income markets, you are pricing more of the recession risk, a little bit less probably in terms of our team's analysis for equities.
Well framed, as always. Andrew, thanks for that. Andrew Balls there of Pimco on the rates market and fixed income right now, with some really important points at the end there. The number one question in March, to what extent would the financial stress be a substitute for rate hikes? And that was part of the rate cutting story as well, Lisa. We thought you'd get this big spillover bleeding right the way through the financial system. There was a worry that would tighten lending standards, and that would mean the Fed may have to ease, not just fall back on more hikes, but actually ease.
Which is the reason why Binky Chadha is saying that equities are not pricing in a banking crisis. You wonder, are bonds still pricing that in, with 3 rate cuts by January being priced into bond futures?
Fantastic lineup on the bond market this morning. So that was Andrew Balls of Pimco. In about 50 minutes, Steve Major of HSBC. Steve Major here in New York.
It'll be great to get a briefing.
That's very cool. Yeah. Looking forward to that. Yields higher on a 10-year, 353.94. Yields higher by a couple of basis points. The equity market just about unchanged.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, gunfire and explosions rocked the Sudanese capital for a third day as diplomats intensified efforts to stop clashes between the army and a paramilitary group from escalating into a full-blown civil war. A long simmering dispute erupted this past weekend into a battle for control of the nation. Nearly 100 people are reported to have been killed. The Delaware judge overseeing a voting machine company's $1.6 billion defamation lawsuit against Fox News has announced a one-day delay in the start of the trial. Jury selection and opening statements had been set for today. The case centers on whether Fox defamed Dominion voting systems by spreading false claims that the company rigged the 2020 presidential election. Japanese Prime Minister Fumio Kishida resumed election campaigning over the weekend as a smoke bomb was allegedly thrown at an event attended in central Japan. Kishida was evacuated unharmed from the site, and a 24-year-old man is said to have been arrested. The attack comes just weeks before Kishida is set to host the group of 7 world leaders for a summit. UK Prime Minister Rishi Sunak is expected to receive a boost this week as inflation slips back into single digits. It's raising hopes that the quickest series of interest rate increases in 3 decades is nearing an end. Figures this week are expected to show inflation dipping below 10% for the first time since August and a cooling in the labor market. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The banking crisis is a crisis of the banking system. This was a banking tremor. A few banks that were caught offside and badly supervised went down. The big banks are just fine, and we're seeing that. In fact, the big banks are benefiting from this because they've got two things. Not only are they viewed as safe, but they've got diversified business models.
The numbers at the big banks, absolutely incredible. That was Mohammed Al-Arian, Bloomberg opinion columnist and Queen's College Cambridge president, joining us at the International Monetary Fund global headquarters in Washington, D.C. on Friday. Tom, the numbers, net interest income, JP Morgan, up more than 40%. Wows, up more than 40%. Citi, up more than 20%. The numbers phenomenal. Why? Because last year, 12 months ago, in the first quarter of 2022, rates were effectively at zero, and now they're closer to 5. And these big banks are benefiting big time from some of these trends.
Well, they're benefiting from the trends, and what's interesting here is how they're going to massage, the message. I mean, are they going to go down to Congress, get hauled in front about a banking crisis, and then how do they handle that they're minting money? I mentioned the revenue leap earlier for J.P. Morgan back pre-pandemic, and they've just moved way past beyond this with power and strength. They're embarrassed by it.
They clearly attracted some deposits, but I would say they pushed back against the nature of those deposits, Lisa, when the CFO of JP Morgan started to talk about the flightiness potentially of these deposits that had arrived in recent weeks.
The proof will be in how much they raise their interest, right? How much they'll basically offer to depositors, so they can say whatever they want. But the question ultimately is, are they ponying up to keep those depositors, or do they not have to? And I think that's really going to be what'll show whether that's true.
I don't think they need to. Do they need to?
Well, that's the issue. I mean, if you look at the CDs, for example, of some of the big banks, they're much lower than the smaller banks. They're only like 3.75% for, say $200,000 or $100,000.
You've got this valuation hit for the regionals.
Yeah.
Then, Tom, you've got these profit headwinds that are very different to the kind of headwinds that are going to face the major players on Wall Street.
That's the dynamics that are out there right now. And of course, it is an era of capitalism in banking. Any of you that listen to me have known, and John's got the surveillance cork over there to put it in my mouth at any time, I possibly have opined that some of these banking exercises are marketing plans wrapped around a gauze of a bank. This morning, in a brutal story, Nora Burr, Jennifer Serrain, Max Reyes, and Ann Choi put out a definitive story for Bloomberg on the real estate ballet of these troubled banks, piecing it together. Sri Natarajan joins us here. And this goes from the zip codes of Beverly Hills out to the Hamptons. The maps, Sri, are what are devastating. Explain not the con job, but the free lunch that was given. You're a fancy hitter, way above John Farrow's level. It's on the edge of Farrow. You've got a house you want to buy, 4,000 square feet in the Hamptons, and boy, is there a bank there to help you.
If you're on the edge of Farrow and squarely in Tom Keene territory, First Republic is going to jump in and offer you interest-only loans. Now, we'll all remember back in the global financial crisis, 2008, when you think about the real estate bubble, the kind of loans that were the speculative loans that were being offered for the purchases being made, those were to risky lenders. It's a very different dynamic here. First Republic is a bank that had marked a niche for itself by catering to the wealthy and the uber wealthy. They went out there and offered these interest-only loans where you're only paying interest for the first 10 years. You're not even recouping principal for a third of your regular mortgage period of 30 years. And unfortunately, what has changed from 2020, 2021, what you were just talking about, Lisa, we've gone from 0 interest rates to about 5% interest rates. These loans have lost value. So unlike Silicon Valley Bank and Signature Bank, where the securities portfolio of these banks were the real trouble, at First Republic, it's something else. It is really their real estate mortgage book, the jumbo loans that they were making, about 20 billion plus hit just on these types of loans on their mortgage book. And that's a problem, and clearly why we haven't really seen an easy solution for First Republic yet.
So I got $7.7 million property in Southampton. I'm going to get an interest-free loan as a mortgage, right, from the bank. And do I understand our reporting is principal repayment on that was delayed 10 years often?
Correct. And that's one way to attract customers. And they got some of the biggest names on Wall Street to bank with them, including bankers from other prominent institutions choosing to take out their mortgage with First Republic, because these are all people who are trying to make sure that they can save that extra penny and invest it wisely.
John, the First National Bank of Abramowicz is coming in to pick up this loan portfolio. Am I right? There's nothing to pick up?
It's impossible. When you have a $27 billion hole in your balance sheet, twice the size of your equity, you're really looking at anyone even coming in with, paying $0 per share, still having to take a $13 billion write-down. Why would you do that unless there are some really good sweeteners added in there by the government?
Let's take a look at State Street. So State Street right now, net flows disappoint. The stock is getting absolutely hammered. I have to say, it's down about 7% in the pre-market at the moment. Net interest income came in a little bit lighter than expected as well. There's a really interesting headline here that I'd love, Sri, for you to translate. The deposit into FRC resulted in a $29 million provision for State Street. Can you just translate what's been going on over the last month with these financial institutions getting together and trying to support First Republic?
It's a very interesting dynamic. So last month, we had 11 of the largest banks in the country, including State Street through JP Morgan, pulling together some $30 billion in deposits, their own cash, and saying, we will park it with First Republic. It was supposed to be a sign of confidence. But unfortunately, how accounting rules work is it's not just on loans that you have to take provision. You have to be willing to take provisions for any place where you can see a possibility of a loss. And even though this is not a signal that First Republic is not going to return their money, the rules are such that most of the banks that took part in this exercise had to take a roughly 2% provision. At State Street, it sounds like about $30 million, but at some of the bigger banks, it's closer to 100, a little more. Yes, First Republic, this is not a sign that First Republic will not be able to return their money, but at the same time, it is an acknowledgement that the move, that public relations exercise, that confidence-building exercise was not entirely risk-free.
There are a couple different issues that are coming out with some of these earnings. Some people saying that the First Republics, we started talking about their interesting mortgage scheme, how there were a number of poorly managed banks or those that took on undue risk, and that they haven't fully been worked out of the weeds yet. And then you have the profitability issue that we're seeing with State Street. From your assessment, which is the more pressing narrative that you think accurately reflects whatever kind of banking situation we're in right now?
It certainly still is the issue with the regional banks. The way we're describing the whole scenario that's panned out over the last few weeks, we've gone from calling it the banking crisis to a crisis for some banks. And that is entirely the case. We've already seen a couple of banks fall. We will most certainly see a wave of M&A that will follow after we get certain clarity. And as Jamie Dimon and Warren Buffett and others have said, there will most likely be a few other banks that will still fail. Investors are trying to figure out which those banks will be. Those banks are probably going out there and trying to find out rescue solutions or inject liquidity into their balance sheet so that they can ride this out. But there is still some trouble on that front. Everyone seems convinced that the domino effect that could affect the entire system has perhaps, the risk of that has lessened, but that doesn't mean that there aren't some banks that will still go through a world of pain.
Sorry, just a final question then. What are the banks this week that you're focused on? Now, traditionally, you'd just say Bank of America, Goldman, Morgan Stanley, but seemingly that's changed this year. What are you focused on?
It's incredible. Like every bank earnings seasons, you are looking at the biggest banks in the country, whether it's a major investment bank like a Goldman Sachs or a Morgan Stanley, or you're looking at a JP Morgan to get a health of the corporates in the country, to get a health of to get a pulse on the consumer. This year, unfortunately, while we're all paying attention to these bank earnings, everyone's really interested in the flurry of regional bank earnings that we will see in the days after the big banks report, because that's where the problem still remains, and that's where all the attention is focused.
Is it a name like Western Alliance later this week? Is that something you'd look at? Which names will you be looking at?
We would definitely look at a name like that, and also every other bank whose stock got hammered.
Yeah.
First Republic might have lost 90% of its market value this year, most of that in March alone, but there were several other banks that are severely off their mark from the start of March.
First Republic, I believe, on the 24th. I think so, a week from today. Sri, thank you. Just wonderful.
Thank you.
Some really, really interesting stories here, Brahma. We've got to work our way through. The big banks are doing great. We can see that in the numbers on Friday. JP Morgan, Wells Fargo City, going to hear from Bank of America tomorrow. We've got it. Clear. Message received. What about the others?
Well, and that's why the reason why you mentioned State Street was so interesting, because their net interest margins came down or were not as high as expected. Their provisions for loan losses much higher than previously expected.
Still sees a share buyback program of up to $4.5 billion for 2023. So no changes at first look to the capital return expectations, Tom.
I'd look for bank consolidation, which will make Shree's job early. He's only working like a 35-hour work week as it is, and he'll be able to cut it down to 32 hours.
I would see that
with bank consolidation.
That lazy over in the banking team. Yeah, I hear the same thing. Not at all. Shree, thank you. Thank you, sir. Equity futures on the S&P positive 0.1% on the S&P 500. David Bain at Citi joining us next. We've got another busy week ahead. This is Bloomberg.
The market has been climbing this wall of worry.
When you change the interest rate paradigm as quickly as we did, you will catch people offside.
The consumer will probably slow down a bit in the second half of the year.
You look at what's happening in the U.S., policymakers are still grappling to see where they are in terms of growth, inflation, etc.
Economic policy is not in the driver's seat anymore.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The market has been climbing this wall of worry.
When you change the interest rate paradigm as quickly as we did, you will catch people offside.
The consumer will probably slow down a bit in the second half of the year.
You look at what's happening in the U.S., policymakers are still grappling to see where they are in terms of growth, inflation, etc.
Economic policy is not in the driver's seat anymore.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. Not a boring Monday. Really interesting. Deeper into the bank earnings season. And with that, also a huge snapshot this week on the just under 7% mortgage. John, unspoken this week, there's a lot of housing data, and it does, as Andrew Balls was saying about credit conditions tightening, you really wonder where that dynamic will fold in with the banking dynamic and as well commercial real estate.
So let's pick up on the banking dynamic and sit on that for a moment. We're all following the data. And we've said repeatedly, it's not CPI and payrolls, it's about data elsewhere. So let's go to the Federal Reserve. The Federal Reserve give you some data on just how many banks are coming to them to borrow funds. That gives you some idea of how much stress is in the system. That's stabilized. That was Thursday. Friday, we had some bank lending data also from the Federal Reserve. Also starting to see just some growth, some bounce back there. That's good news. You put that together with the big banks, they look super profitable, widely expected. Now it's to the small banks. I want to know about lending standards. Then we get some data in early May. The Senior Loan Officer Opinion Survey, that's key for the Federal Reserve. And we return back to the question that dominates economics in the Federal Reserve right now. To what extent is the stress of the last month a substitute for rate hikes for the Federal Reserve? And slowly, we're going to find out the answer to that.
And part of this is back and forth between financial stability into what we usually talk about, folks, monetary policy. David Bain joining us in a moment with interest. But all of it is the tea leaves of where we are. The Bramwell cam is on Abramowicz as she looks at Charles Schwab, San Francisco. What do you see, Lisa?
Well, this is sort of interesting. It's sort of a motley picture here because on one hand, the earnings per share beat. They came out with a first quarter adjusted EPS of 93 cents versus the estimate of 90 cents. Their net interest revenue also above expectations, $2.77 billion versus $2.74 billion. A lot of positives, and yet their deposits came in under 325.7 versus 325.9. So here's the question right now. They also decide to pause active share buyback program, and that is setting the shares significantly lower in real time. How do some of these firms manage at a time when people are skeptical of whether they are getting the best bang for their buck? They want the interest, and it's not clear where they can get it most.
You measure by action and character to your shareholders. They've got a dividend increase there. You know they didn't argue about that. Let's show the might of Charles Schwab. John, a 1.97% yield, and I've got a 5-year net dividend growth of 21% per year. So that's Schwab saying we've got use of cash. We're going to distribute to shareholders given all this turmoil.
The stock has been absolutely hammered. We're down 39% year to date, Tom. That stock has got caught up in all of this in ways that sometimes I have to say, Lisa, didn't really make much sense.
Agreed.
On some days where it was getting absolutely hammered, but the stock's been absolutely hammered year to date, and we're down, a couple of tenths of 1% of the pre-market? Let's call it unchanged
bouncing
now.
all over.
Let's call it unchanged, Lisa, on Schwab.
Yeah, it's been bouncing all over. The larger story is, are we going to see this bifurcation between the haves and the have-nots, the biggest and the not so big, or the second tier? And are we seeing that in real time? We go back to BlackRock versus State Street. State Street shares down significantly at a time when Morgan Stanley analysts see BlackRock's assets under management climbing to 15,000 in the next couple, 15 trillion, excuse me, in the next couple of years. So at what point is this really just, survival of the fittest, survival of the largest that we're seeing increasingly throughout the banking sector?
In a monster way, we're seeing that for the big names. We saw that with JP Morgan on Friday, Wells Fargo on Friday, Citigroup on Friday. Tom, I imagine we'll see it from Bank of America later this week. We get B of A numbers tomorrow. For the broader economy, though, it goes beyond those big names. It just comes down to one thing. Are we going to see a severe tightening of lending standards at these smaller regional banks, which will have an outsized effect on the broader economy, Tom? And that remains to be seen. And I don't think just because we've had good numbers from JP Morgan, Citi and Wells Fargo, that the coast is clear on that front. There are a number of regional banks reporting this week and next week, which will offer us a clearer picture of things.
And part of its rate of change, I mean, is liquidity, solvency, and things. Is Mike Wilson said of Morgan Stanley, this adverb suddenly shows up. I don't know how suddenly it is for Charles Schwab. But, John, we're modeling out off the Bloomberg. Pre-pandemic, they did $5 billion in operating income, OI, and basically they're doing a double on that out to 2024, 2025. This is a profitable company. The operating income margin, John, is 40 cents on the dollar. Jamie Dimon would love to do that. I mean, really, really love to do that. So I'm not so worried about Schwab as some of these smaller, less visible banks where there's a real mystery.
And the real people who've got to worry right now are the people that depended on these regional banks to borrow money for banking services, Lisa, and we're going to see how that develops, Tom, in the coming months.
Let's do this. Let's do it just because of time, and we've got a really important guest with us right now. John, I'm just going to look quickly at the data and start off with dollar, some resiliency this morning after the challenges last week.
Yeah, I'll keep it brief as well, Tom. Futures positive by a little more than 0.1%. It's a slow start to an otherwise busy week. Lots of bank earnings, lots of Fed speak. Lisa's going to guide you through all of that over the next couple of days. The 10-year yield higher by 3 basis points. The 10-year right now at 3.54. The euro against the US dollar just short of 110 after breaking that level to 110.76 on Friday. Tom, we're back down to about 109.78.
One of the great voices of Wall Street counseling patience in a reach out 3 years is David Balin, Chief Investment Officer, Global Head of Investments at Citi Global Wealth, who had a certain courage through the pandemic to say, stay in the market. David, you lead your essay. It is not easy to be an investor right now. How do I have confidence to stay in stocks?
Well, right now, Tom, we're sort of 2/3 through the bear market. And what's standing between us and a recovery in portfolios is the recognition of what earnings are going to be and what the level of recession that the Fed anticipates and has actually talked about now actually occurs. We think that earnings, are going to go down probably between 7 and 10%, much less than what analysts are expecting in terms of they're actually expecting growth. And the second thing that you and your team have just talked about, which I think is critical, is that we already see further tightening due to bank lending standards, and we see it across several data sources. First, we already see that banks are lending less, that the actual amount of outstanding loans are going down. Second, we see the reporting by companies of the fact that lending standards are already tighter. And third, we actually are going to see that the ability and capacity of small and medium-sized banks to lend is going to go down as a result of almost $500 billion of deposits moving into treasuries and money market funds over the last 3 months. So these are already constraints on an economy that is already slowing.
David, we've been talking all morning about the dispersion, the sort of disagreement between bonds and stocks. Bonds seem to be pricing in rate cuts on the heels of exactly what you're talking about, credit restriction that really just escalates throughout the year. And you see stock traders kind of shrugging that off and saying things are still all copacetic. Who do you think is right?
Well, the bond market looks to be right for the moment. What's interesting is that, bonds have rallied extraordinarily, and you've talked about this for the last, 5 weeks. The 2-year and the 10-year have moved, yields have moved dramatically lower. The stock market is anticipating and saying, well, that's great. The discount rate for stocks has actually gone down. Bravo. But really what's happening is that the bond market is saying we have to be much more vigilant about where their earnings are going to go down and where they're going to go up. So companies that have moats around them, different technology companies and other, industries where you can see both margin growth and revenue growth should be rewarded. But you've seen, the bank stocks in particular and some of the ones you've been discussing this morning do poorly. And the industry averages, the S&P and stuff has been largely range bound since October of last year. So what we have to see is this digesting of what really is going to happen with earnings in order to be able to look into 24 and 25. And when we do, I think we'll see a substantial recovery. But again, we're 2/3 of a way through a bear market in equities.
Earlier this year, people were talking about going outside the U.S. to Europe in particular as a place, particularly because the ECB was still raising rates, potentially much more than the Fed was poised to do so this year. Do you still see that as the narrative that could drive investment theses, or do you think the U.S. looks like a better place to park simply because it will go through the cycle quicker and there will be more pain on the heels of some of the rate hikes elsewhere?
It's a great question. If I had to predict one thing that we would be writing, just a month or two from now, it would be that, emerging market exposure is going to become, or non-U.S. exposure is going to become extremely important. Right now, we are near, the third highest dollar peak ever. We haven't come very much off of that. And valuations for non-U.S. stocks, and especially emerging market stocks, are at all-time lows. So if you're a U.S. investor today, you would like to buy companies, right, in industries outside of the U.S. to take advantage of both the disproportionate devaluation of those shares, as well as the fact that the dollar is going to fall. I think it's going to be a major source of income for us, for profits for us over the course of the next 2 or 3 years.
You're not alone, David. We've heard that a lot. David Bain there of Citi Global Wealth. Look at the energy names last week. LVMH, now the biggest company in Europe. You've got Hermes, great numbers from both of them off the back of the reopening in the China story. David also mentioned there that tightly defined range on the S&P 500. Let's just take the year-to-date range. Lisa, 3,800-ish at the low end, 4,200 at the top end, and very, very close to the upper end now of that tightly defined range.
But the battle underneath is so intense, the battle for leadership.
The churn.
The churn. Well, it's basically this question of, well, how long can tech lead? And is this idea that the Fed's going to cut rates going to benefit some of the more interest rate sensitive areas, or is this going to be different? Is this time different?
That should go on a promo. The battle for leadership. That movie voice.
I'm watching.
Or at least be
movie
written
trailer voiceovers.
Be
trying.
Written up
auditioning
in Lisa's newsletter, Toxic Brew. Could you see it written up in
What's
Toxic
that, Tom?
Brew?
How is Toxic Brew going?
It's fantastic. The battle for leadership.
The battle for leadership.
Nice.
Subscribe.
Right, it's Happy Monday.
Subscribe.
Yes, indeed.
Should we promote the daily newsletter now?
Sure, yeah.
Let's do that. Daily, subscribe. Bloomberg.com/surveillance.
Right, we're done.
What's great, seriously.
Thank
you.
I read it. It's actually brilliant. I really enjoyed it.
I don't have any equity in this thing, but it's got great links. It's not just, blah, 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 blah. It's like, look at this, look at that.
Well,
it's important.
There are
It's a time
themes
saver.
that go through all of our discussions with our guests that are fantastic and really highlight the main debates. It's why it's important. It's what you guys talk
You're
about.
finding rhyme and reason in the chaos that is this program. It's truly impressive.
Well,
I just had one eye on Steve Major. Just saw him walk into the office. Very cool. Steve Major from HSBC joining us in about 20 minutes from now. I also understand we're going to touch base with Ed Ludlow on the West Coast. As Tom, we're going to get this rocket, deep space rocket Starship from SpaceX.
We don't have time right now for it, but it is complex. The complexity of this rocket deep into space is not like Apollo. It's different.
We'll make time for it next on Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Now let's get to that rocket. SpaceX set to launch its massive deep space rocket Starship into space this morning. These are live pictures. Now, if successful, that test flight will be a critical milestone in the company's ambitions for manned missions to Mars. NASA also plans to use the same spacecraft to return to the moon. Once operational, Starship will be the most powerful rocket ever built. First Republic Bank has lost nearly 90% of its market value this year. Its stockpile of low-interest loans is being blamed. Now, many of them have been to wealthy homebuyers and property investors with high incomes and good credit scores who have years to start paying them down. The mortgages are performing well, but the low rates and delayed repayments hurt their value. Analysts are estimating a big drop in deposits. And another sign of mounting pressure on the banking industry. Barclays is responding to a slowdown in deal-making and capital markets businesses by cutting about 100 roles in its investment banking group. The London-based lender already let go of roughly 200 positions from the same division in November. And Merck is set to buy biotech company Prometheus Biosciences for about $10.8 billion. The agreed price is a 75% premium to the target's closing price on Friday. Merck is looking to bolster its research pipeline and strengthen its portfolio of autoimmune drugs as it faces a losing patent later this decade. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Like soap opera, because when I first made the offer, the response was the board adopted a poison pill. So they were like, hell no, you can't buy Twitter. We'd rather die. We'd like to chew on cyanide before being bought. So that was their initial response.
And then you said, actually, I don't want to buy it.
Yes, and then they said, no, you must buy us. Gun to the head, you have to buy us. I'm like, are you the same people who said you'd rather die than be bored?
That was Elon Musk there. I guess that $44 billion offer looked a whole lot more attractive as the year grew older and tech got absolutely hammered. That exchange between Elon Musk and the BBC last week, must-watch television. You have to find that interview and watch the whole thing. Welcome to the programme. Elon Musk did a series of interviews over the last week. The attention this morning away from Twitter for very, very good reason, Tom, and onto SpaceX, which is doing some phenomenally interesting things.
They're doing interesting things, and it's not, I got to really be careful here, folks, in that there's a lot of citizens up in space, and then there's the science of this, which, John, is what propulsion do you need to get comfortably to the moon? Saturn could barely make it, and then onto Mars. This thing today is taller than the Statue of Liberty, and it has 30x number of rockets separate on it. This is a ginormous candle that is going up into space. It's an orbital flight to test. There's no men on board, no women on board. But this is the science. When you hear rich guys say, wow, Elon Musk, technology, this is what they're talking about, not the rumors at Twitter about what they're doing with their employees.
And Tom, the focus shifting back to deep space exploration, is that right?
To Mars, yeah.
In a way that the focus shifted away from in the previous few decades.
Yeah, a walk to the moon is 240,000 miles. I don't have memorized the distance to Mars, but what's important is you don't go in a straight line. You know, it's not like, in the cartoons where you go from Earth to Mars. You got to get out there and do a big, big, long curve. Matt Damon's done it, no one else. You get out there and you do a big, long curve, and it takes huge propulsion to move weight up. And if you're going up in a pup tent, Lisa, that's easy, but they're not going up in a pup tent. They got to carry a lot of stuff.
To really underscore that, SpaceX's president came out and said that this is truly a flight test, and the real goal is to not blow up the launch pad.
Yes.
That is the success.
Okay, here's my childhood. It was fractured. What'd you look at? Dad had slides or that. My father would have slides of the family, and about 10 minutes in, he'd put it in an Explorer rocket blowing up on the launch pad. He thought that was fun. And I'm sorry, folks, there's some real tension to this liftoff today. This isn't normal, is my major
So Ed's going to probably tell you this in a second, Tom. In fact, he will tell you this. This is a test attempt, so you're going to see potentially a lot of stops started through the morning. And I still don't think I've really got a time for this. I think maybe 9:20 Eastern. I think that was the last thing I heard about an hour from now.
Yeah, it went from 8 to 9:20, and they had to wait for Ed to wake up and get his coffee.
Well, he's awake
in San
now.
Francisco. Ed Ludlow with us right now, the star of Bloomberg Technology on the astronaut watch today, an unmanned flight. Seriously, Ed, what's the risk here to this launch?
The risk is that it's a very expensive test. At its most profound, it proves that the technology works as a launch system. You talked about Saturn V. Starship in its most complete form has twice the thrust, 16.7 million pounds to Saturn V's 7.6 million. So at its most profound, that's it. But you guys kind of nailed it. They just want to know it can get off the ground without melting the launch tower.
I mean, they're really important. And what the great thing here is 30 years ago, it was assumed to go to Mars, we needed some form of fusion launch, a nuclear a nuclear propulsion engine. That's not the case here, is it?
No, largely methane-powered. Methane mixed with oxygen is the propellant. And you make an interesting point. You know, Elon Musk did a Twitter Spaces last night for subscribers only, where he spent an hour trying to set the bar very low. That all they want to know is whether the system can get off the ground detached. They're not going to try and recover either the booster or the spacecraft. The booster will fall into the Gulf of Mexico if it even gets off the ground and sink. The Starship spacecraft will hopefully reach orbit, but when it falls back down to Earth, it will splash 140 miles off the coast of Hawaii and not be recovered. This is a system that's been worked on since 2005, Tom, and it goes back to this idea that Elon Musk isn't always accurate with his timelines, but he does get there in the end. So this is kind of a big proof of concept moment.
Ed, traditionally, this was the territory of a federally funded kind of program, and suddenly we have a private company doing this. What is the business case to get a rocket to go to Mars?
Well, you have to remember that Musk's ultimate goal is to make mankind a multi-planetary species. You know, you guys were discussing Mars, but that is ultimately the goal, and there the business model is not clear. What SpaceX has done is change the economics, right? This took $5 billion to develop. Saturn V, by comparison, in 2020 dollar terms, took $50 billion to develop, a factor of 10 greater. The business model, interesting. In the first instance, there's a NASA contract, about $3 billion for SpaceX to use Starship to get to the moon as the moon landing system.
Yeah.
That dollar comes from the public. And then internally for SpaceX, the idea is that the payload capacity of Starship is so much greater, it's a more efficient means of getting Starlink into orbit and deployed in constellation at a cost that's much cheaper than they're currently doing it.
Ed, for those who like science fiction, I remember that the big challenge was always getting back from Mars. If you could get to Mars, you couldn't carry enough fuel with you to get off of Mars to get back to Earth. So is that discussed at all in terms of returning, or is this just basically, let's see what we can do, and then that might help in the quest to go to the moon?
Lisa, when I woke up this morning, I was bracing for Tom Keene to ask me that question, not you. In the first instance, the step that's missing is, even post-orbit, the long-term plan is for SpaceX to launch Starship, refuel it in orbit, have a vehicle already in orbit to couple with and refuel it and get it to Mars. Wow. To your question, they have to launch with such capacity that whatever they're sending to Mars has to give them the infrastructure that localized fueling can be established for the return journey. And, you know, Musk has talked about this pretty openly, right? He wants to die on Mars, not on impact. But you also don't want it to be a one-way ticket. And that's a big part of the strategy that we're years away from getting to. Even last night, you know, Musk admitted we are many years away from Starship making regular orbital flight just outside of Earth's atmosphere. So Mars is a very distant goal at this point.
Amazing. Just amazing. Ed, you and I are going to catch up about this again at about 9:20-ish. 9:20 Eastern Time, when we expect that test attempt to take place. Maybe. Maybe. We should catch up regardless. Ed Ludlow, thank you, sir, on the West Coast on the latest. Truly expert. And Lisa, you asked the TK question. There you go.
Well, I love this stuff. It's so interesting because the one-way ticket idea isn't very lucrative, right? I mean, it's basically if you're going to have a business model and you're basically sending people to never return,
It's sort of like looking at JP Morgan's balance sheet. We don't understand the scope and scale. And what's so important here is the moon hangs up in the sky, and you go, geez, I wish we had two moons like Star Wars. But they're only 240,000 miles away. Okay, Mars is 150 million miles away. The scope and scale, all of us, including me, really can't imagine. And that's a starting point of how far away Saturn and Jupiter are.
When you see military aircraft refuel in the air, I'm pretty impressed by that still. And that's been going on for a long time. Can you imagine trying to do that in space?
Yeah,
cool.
In orbital speed.
It's so cool.
Yeah.
I mean, if you think about it, it takes, 9 months going at the current speeds to get to Mars, to be able to get that amount of fuel in space and then come up with the infrastructure to refuel on Mars. Look, it's all pie in the sky kind of stuff, but it's not. And that's the reason why it's so intriguing.
I think the important thing is you got to get home. That's the hard part.
Abramowicz point.
On the Apollo mission, everything was focused on the majesty of getting there, going around the moon. Mike Collins in the first trip up there while the other two went down. They had to get them home. And that was really what they focused on.
Up next, in the next hour, we'll do markets for you. Counting you down to the opening bell about an hour from now. Brian Levitt from Invesco, New Edge Wealth, Cameron Dawson, Calvin C. of BNP Paribas. Looking forward to that conversation. That feels like a downer, doesn't it, after what we just discussed? We're going to talk markets in the next hour. Steve Major in the building from HSBC on fixed income, joining Bloomberg Surveillance.
West Ham.
Next. Very, very cool. Equity futures on the S&P 500 just about unchanged. Yields a little bit higher by a couple of basis points. Your 10-year, 3.54. Back in New York altogether, and good to be back. This is Bloomberg.
Bloomberg Surveillance, good morning, everyone. Lisa Abramowicz and Tom Keene. John Ferro preparing for Space Hour here at 9 o'clock, a scheduled launch, seriously, of Elon Musk's absolutely original rocket. Thanks for the feedback going forward. They called it a nerd out we were doing there. It was very good. You and me fired up.
I don't think there was really much other way to describe it.
Yeah, but it's, we're going to do that in the 9 o'clock hour. Seriously, we'll have some really good perspective with Edward Ludlow on a technological basis there, Bloomberg Technology. Right now, we're going to look at Bloomberg Economics. Michael McKee joins us here quickly. On Empire Manufacturing, Mike, why is a guy like you wasting time on a tertiary statistic?
Because it's a big move in the Empire Index and because there's nothing else to trade on today unless you're betting on SpaceX one way or another. The headline number rises 35 points to the first positive reading in 5 months, from negative 24.6 to 10.8. New orders go up 47 points to 25.1, and shipments up 37 points to 23.9. Very rapid increase or improvement, if you want to call it that, in the Empire Index. Prices paid dropped 9 points down to 33.0. The work week is up, but still negative. The number of employees improved, but still negative. But in general, much better outlook from New York manufacturers.
And the two-year yield, 4.16%, gets my attention. We'll do that with Steve Major here of HSBC in a moment. Michael, we've got to pause. 10 years ago, this horror at the Boston Marathon, and today there's the celebration of the Boston Marathon, a little late this time around. And the Red Sox will go up against arguably the greatest unknown pitcher of our lifetimes. Mr. Ohtani will pitch today for the Angels. Tell our international audience how unique this guy is. It's once in a lifetime.
Oh, I think probably most people in the world have heard of Shohei Ohtani. He is not only perhaps the best pitcher in the American League, he is perhaps the best hitter in the American League. And nobody plays both ways except for him. So it is
absolutely unique.
You would go to Fenway on Patriots Day anyway if you could sneak out of work, but to see him pitch would be
never
a great thing. And then you're forgetting tonight.
Tonight, there's the Bruins
playoff
start.
Yeah.
They've been almost as successful as West Ham. We'll see how that goes. Michael McKee on Empire Manufacturing, a constructive positive number, red and green on the screen right. Now, Lisa, just a quick comment here before Steve Major on a good number there, and 4.16% on the two-year yield.
You call it tertiary, and yet the fact that the bond market moves as much as it does on this tertiary statistic is interesting. I'm looking right now at 10-year yields popping up to 3.55% from as low as 3.51% earlier this morning. This feeling perhaps the underlying strength and inflationary force is greater than some people previously thought.
A huge debate, and of course our theme on this Monday morning is the many narratives that are out there. Stephen Major is Global Head of Fixed Income Research at HSBC, joins us here and on through this half hour. Stephen, you are iconic for a lower yield call. There is a camp aggressively looking for lower yields, led by the IMF in a stunning 5-year GDP projection globally. Reaffirm now the low yield call.
Yeah, the IMF also have identified the low R-star numbers
I know you're not a big fan of that, from what I've heard.
Well, I had to be yesterday. On Friday,
yeah.
I was sitting next to Olivier Blanchard on
really?
Friday at a panel, so I had to I love our start on Friday.
The reason you have to be a fan of it, or at least consider it, is that you need an anchor in your process. Now, the word anchor is sometimes taken negatively, i.e. that you're stuck, you can't change your mind, but I like it as a sort of ballast to the thinking process, in that we're anchored around this low R star because we seriously believe it. We believe that the debt levels in the system and the demographics and the total factor productivity, these are key drivers of this destination point. Now, most people seem to spend nearly all their time talking about the policy rate today.
Right.
But you need both. And I think it's completely reasonable to have that debate.
A strategist away from what you do is Ian Lingen, who's widely acclaimed in America.
Yeah.
And he aggressively said today, the 10-year, 3.56%. If it gets to 3.65%, that's a buying opportunity, yield down, price up.
Yeah.
Do you have that nuance now, or are you just saying buy the 10-year?
Yeah, well, no, I think people look at me, they read the stuff, and they think I'm just one way, just a bomb bull. And I guess you guys have done that to me as well, right, over the years. And it's fair enough. I guess consistently we have forecast lower yields. There's a tactical overlay as well. We want to buy at cheaper levels, right? So I think somewhere between here and 3 3/4 is a good entry level. If someone says 365, then really you want to go in at 364. but you know, I think it's very difficult to imagine us getting back to 4% on the 10-year.
I'm actually less interested in the tactical movements than I am the sort of larger destination call, because that is one that I have never seen such a disagreement on as I have seen now, where so many people say this is a new era, that the fragmentation that we're seeing with China and with the US and with Europe is going to lead to higher costs, that we're going to see some sort of more persistent inflation. Why do you push back against that?
Well, look, I respect these views, and we have to try and consider all available information. It's intuitively quite logical what you just said. So defense spending, the transition to net zero, there are questions about the behavior of aging populations as well. So they could change. So there's all sorts of pushbacks to the lower for longer view. But the thing is, I don't see much science in any of this. And I've got an observation that goes back 4 decades that says that there is a trend in place, and the higher debt has been associated with lower yields, and I dare say it's even causal. Now, until we can overcome that, until you have a tipping point and it goes the other way, I think that's the central tenet of the hypothesis, if you like. And in science, you need to be able to reject that. And what I hear at the moment are anecdotes. There's going to be this, so this will happen. Well, really, where's the? I mean, there's a lack of rigor around the whole thing.
Well, although you could say this is a very quickly moving story, and that before the past 4 decades was a different inflationary regime, and some people would argue that the fact that we've seen such resilience, as evidenced today by that early New York factory data, shows that perhaps there is more steam behind this recovery, more steam behind this inflation and growth than people previously have gave credit for.
Yeah, fair enough. Look, the inflation is high and sticky, and it's not going to get back to target anytime soon. But we've got so many other things to consider. And to me, the common denominator behind a lot of the themes that keep running through the market is the debt. Now, you spent a lot of time on this program talking about the bank stress. That's one sector of this economy. Not just the global economy, of this economy. And the common denominator that runs through all of these inflection points seems to be debt. It happened to crypto, it happened to SPACs, it happened to the UK pension industry, and it's just going to keep happening.
Well, and it's also going to pressure, to your point, fiscal spending. So there's not going to be the same kind of ability to spend on some of these things that people are talking about because of that overhead, that weight of the debt. So where we are right now is this idea where people don't necessarily say that they agree with you and they fight back against the IMF, but they're trading as though they do. They're trading as though they're going to see rates get cut significantly by the end of this year. Do you agree with that?
Do you know, this right or wrong or agreeing or not doesn't really matter. And in fact, the most frustrating thing for me is meeting people who totally agree with me because they want the confirmation. And then you meet the others who completely disagree, and it doesn't seem to be much in the middle. And so it's not about right or wrong, right? It's the process and it's the thinking behind it that matters.
The wall of money that's out there. Sir John Templeton told me once in my youth that there would be a shortage of bonds. That's exactly what he said.
Yeah.
There's a wall of money out there and a shortage of bonds, to the Steve Major belief of a broader view. And Blanchard, I think, totally agrees with you on the trend is in place of a lower R-star, is price up, yield down.
Yeah.
How much price up, yield down? The how much of this off the 10-year benchmark, can you model a sub 3% 10-year yield from here out X number of quarters?
Quite easily. I mean, our forecast is 2.5 for what it's worth. The lack of safe asset, to me, is a paradox. Because after all these years of QE, trillions and trillions, surely there's plenty of safe asset out there. Well, actually, there's too much of the wrong kind of safe asset. You see, the excess reserves created by central banks to buy the bonds in the QE, that's not something that you and I can access. Mm-hmm. Lisa, you can't get excess reserves, right? You have no, that's for banks only.
Only my
right?
kids.
What you want are T-bills.
Yeah.
You want T-bills, and there's a lack of those. There is not enough T-bills around, right? So globally, there is a lack of liquid, safe asset. Mm-hmm. That is still the case. So why are people surprised that the 2-year yield can sit 100 basis points through the money rate? Why would you be surprised about it?
Because the price is bid up.
Because it's factoring in the average policy rate for the next 2 years. It's saying it could be 5 for 8 months, it could be 4 for 8 months, but it could be 3 for the next 8. The average of those 3 numbers, I believe, is 4. So it's quite possible, right?
Math with Steve Major on a Monday morning. The joy is we're going to come back with Mr. Major. He's with HSBC, and I really want to focus in on an overview of his rate structure with the idea of some form of stagnation. He's in Hong Kong, where there's no gloom. There is a burgeoning and opening China that will be important. What's your observation right now, Lisa? What do you see?
This is the big debate. Where are we heading? Is this a new era? And you have the people who are arguing that it is getting louder and louder, that this Fed may cut rates and that they might necessarily adopt a more accommodative stance. But that will be with the consequence of higher inflation for longer. And then you have Stephen Major, you have the IMF coming out and saying debt in and of itself at these levels can be disinflationary, can really be a weight on growth, the ability to spend, et cetera. And why are you going to deny what we have seen for the past 4 decades and that trend carrying on into the future?
Without question, the heart of the panel I did at the IMF on Friday is the underlying factors, as Professor Blanchard says, are in place, including technological change and including the Asia experiment.
We have not been able to get this data right. And that's sort of the angst overhanging all of this, is that we're not able to really throw a dart on a dartboard and understand where we're going to head from month to month.
Works in Ted Lasso, and Nate Shelley went over to West Ham. Did you see what he's done at West Ham?
Do you actually think that I have?
It's
Or was that a rhetorical question?
What West Ham did to Arsenal. We'll come back and talk to Steve Major about his beloved West Ham as well. Green on the screen now with a little more persistence. And the VIX, 17.67. I haven't even mentioned, Lisa, that's a bull market VIX.
The VIX is fascinating, back down to levels we haven't seen since January 2022. Crisis over in the stock market, maybe not necessarily in the bonds.
Program note, BitDog down 800 some. I think it's major. Major's in New York City, so Bitcoin's off 29,500. Stay with us with Stephen Major of HSBC. This is on radio, on television, Bloomberg Surveillance.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Well, Congress is concerned about who should have access to sensitive national security information. And now that a 21-year-old airman with a junior job has been charged in an intelligence leak, one lawmaker is calling for changes in the security clearance process. Lawmakers have complained for years about the Pentagon classifying too much information. Nuclear powers within the Group of 7 nations have pledged to end Russia's dominance over global atomic fuel markets. That could cut off a critical source of geopolitical currency for Russian President Vladimir Putin. Canada, France, Japan, the UK, and US committed on Sunday to jointly remove Russia from the global nuclear supply chains. Gunfire and explosions rocked the Sudanese capital for a 3rd day as diplomats intensified efforts to stop clashes between the army and a paramilitary group from escalating into a full-blown civil war. A long simmering dispute erupted this past weekend into a battle for control of the nation. Nearly 100 people are reported to have been killed. Japanese Prime Minister Fumio Kishida resumed election campaigning over the weekend after a smoke bomb was allegedly thrown at an event he attended in central Japan. Kishida was evacuated unharmed from the site, and a 24-year-old man is said to have been arrested. The attack comes just weeks before Kishida is set to host the group of 7 world leaders for a summit. And the Delaware judge overseeing a voting machine company's $1.6 billion defamation lawsuit against Fox News has announced a one-day delay in the start of the trial. Jury selection and opening statements had been set for today. The case centers on whether Fox defamed Dominion voting systems by spreading false claims that the company rigged the 2020 presidential election. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
I do think there's a path to bring down inflation while maintaining what I think all of us would regard as a strong labor market. And the evidence that I'm seeing suggests we are on that path.
The Secretary of the Treasury, Yellen, with Fareed Zakaria over at CNN on Friday, an important conversation driving forward the dynamics. And some of that is dead. And very quickly, at least, I don't want to waste time here with Steve Major, but the Speaker of the House enters New York City today to talk up some form of debt ceiling discussion.
Yeah, well, we'll get a good read on just how much we're running up against that debt ceiling limit probably after tomorrow when all of the receipts from the taxes come in. And then we'll have a real sense of just how close
from the taxes
we are to some sort of default. Yes.
Yeah,
sorry to remind you.
I was up until 2 o'clock doing vet bills 1040. It was really something.
A lot of app products.
This is a joy. With us is Stephen Major, Global Head of Fixed Income Research at HSBC. And for those of you on Wall Street, lean forward now, and we are going to dive into some economic technicalities in the spirit of Steve Major's Asia, living in Hong Kong. I'm going to cut to the chase, where Olivier Blanchard and others see a stable and even lower R-starred, what Ambrose Evans Pritchard at the Telegraph calls the neutral Goldilocks. It's like the perfect rate. They don't have the inflation panic out there. How does the Asian experiment fit into that? We've had COVID, China. You have lived this more than anyone I know. You've lived the quarantines and all that. How does the Asia opening fit into a subdued R-starred?
Well, it's short-term optimism, but it's longer-term realism. So having a growth forecast for China with a 5 handle that seems to be universally approved, seems to be a consensus actually, that's lower than in previous cycles, that's lower than pre-COVID, and therefore it requires or is consistent with a lower policy rate than pre-COVID. Probably means that it doesn't change very much. But look what's been happening these last few years. Build-up of debt, shrinking population in China. Policy pushback against speculative activity, especially in the property market. There have been some long-term changes in China that I don't think are consistent with the levels of growth that you saw pre-COVID. And so look at the inflation numbers. There isn't an inflation problem. Inflation is subdued. It seems to me that you could quite convincingly argue that the policy rate is going down, as well as you could argue it going up. But it looks like the trend is stable.
Gita Gopinath at the IMF has provided real research, leading research with a World Economic Outlook towards this view. And she folds in her India effortlessly, like no one I know on the scene today. She folds in the South Asia dynamic as well. Yeah. How are they linked to this lower R-starred?
Yeah, so India is very interesting because I think most of the local analysts, and I think this is typical actually globally, the worst analysts for any given market are the local people. So if you ask me on the UK, I'm probably going to be terrible.
We do that.
right. So noted. But there is that sort of home bias in the wrong way. But for India, what you see is political uncertainty, fiscal uncertainty, and high inflation pressures. So rates can only go up. Well, in fact, that's the opposite of what's been happening. So that view, based on the simple narrative around inflation and fiscal, would have got you the wrong way around on bonds. So that has been one of the best performing markets recently. Now, again, I go back to the longer run trend. What is the India R-star? It reflects the aging population, the reduced birth rate, and the debt overhangs. So the India R-star is apparently through the US in just over a decade. If you look at the IMF projections, so that's a big yield gap, right?
But there's some really interesting questions that emerge from this. Does it matter how quickly it takes for inflation and, frankly, for the economy to return to that lower R-star? Or do you think it just matters that we will get there and so you can buy bonds now?
It does matter, Lisa. All I'm saying is we have to balance the two. And what I see is a lack of weighting towards the longer-term anchor of the natural rate. The natural rate is an important part of the process. So I think that slowly people are getting round to this, and I think it's part of the explanation as to why bond yields can be lower today than many people have expected.
If that's the case, then we end up in a world that is potentially more stagflationary for a while, and that leads to a slower growth. This is bad for corporate credit, if you think about it, all things being equal. Are we pricing in that kind of scenario at the same time that some people are piling into long-term bonds, the sense that it might be more expensive for the companies to borrow, not necessarily developed market governments?
So with credit, you can look at the history and previous cycles, and you know that the spreads tend not to widen out until the first cuts are in place. Now, if that plays out again, IG credit investors know they can go and sail close to the wind. They know that they can hold on for a few more months because the first cut apparently isn't until later this year or next year. And why is it that the spreads widen out on the first cut? Because normally the rate cuts come with a hard landing. So the idea of soft landing, that's really, it's unlikely. The probabilities all favour harder than softer. That's just based on historical fact, right? So that's why the spreads widen out when the cuts come, because the cuts are normally in response to a hard landing. So with credit, you can sail close to the wind. You can stay neutral to long credit right up to the first cut. Now, that may be a bit cute, but it seems to me that the first rate cut isn't going to be this week.
Partition the dynamic of real GDP and the dynamic of inflation, and you're clearly looking for a diminished inflation. I don't call that secular stagnation. I just call that a global growth, a British growth, a China growth slowdown. I mean, how do you respond to secular stagflation? I just don't buy it.
Yeah, I think that's quite reasonable just to look at the nominal then. I mean, maybe we're trying to be too clever by
strongly support this.
Splitting it all into pieces, and so the idea that you have this real rate that would somehow fit to a chart of real GDP is pretty fallacious. In the same way that the nominal bond yield doesn't really fit with the nominal GDP, right? So it must be at least 20 years ago, I think, since the last time I could see a chart where nominal GDP and nominal bond yield moved together. So the idea that you could have real GDP and real yield moving together, it hasn't been happening for a long time. And the reason is that it's much more complicated than just looking at what's happening in the here and now. You have to aggregate in the next few years.
This has been fine. I've got like 45 seconds or so. I purposely watched West Ham highlights with Arsenal yesterday. Wow, that was exciting. How does West Ham rebuild from the threat of relegation?
Well, they look like, say it quietly, they look like they're almost safe at the moment. It's a shame you didn't watch the whole game because the highlights don't do it justice. After
I'm
10,
American. I'm only Ferro watches the whole game.
After 10 minutes, it could have gone to 7 or 8-0.
Yeah.
I was going to say 0, but this is an American audience, so I have to.
We also have an English audience. We're free for all.
There's no chance we'll understand 0. But it's really exciting. I mean, Ferro's got me into all this. It's your fault as well.
Yeah, it's partly my fault, but Try and watch the whole match sometime.
Thank you. I'll do that. I think I got my marching orders there.
Stephen, this was phenomenal. Thank you so much.
Do I have to watch Tottenham for an entire match? Stephen Major, thank you so much with HSBC.
Forget it.
Lisa, your thoughts on that? To me, this is such a rich conversation, and it's not one or two ways it could go. It's like 4 or 5 ways it could go.
The science underpinning our assumptions, to me, that's my takeaway. People make a lot of proclamations based on logic, but how do we look to some sort of science at a time of such great uncertainty? And this is the difficulty right now. People are coming up with different parameters and making different arguments and looking at different data points. If you look at history and you think of the debt overhang, it does complicate issues. Although you could push back and say, well, if everybody piles into bonds, that's going to lower the interest rate and that'll increase the ability to spend fiscally, and then we get right back to it. So it's kind of a lot to wrap your head around.
Are you going to watch a whole soccer game with me?
I used to play soccer. I would love to watch a whole soccer game with you.
Okay, we'll have to schedule one.
Yeah,
There's,
in 2027.
Well, we'll do that as well. Red and green on the screen, and this is important. Coming up here, John Farrell's going to have some really good coverage with Edward Ludlow of this rocket ship that's going up. It's another day. It's an April day, and this is a piece of hardware that America has never seen. I can't emphasize enough how original this rocket launch will be, and we'll see that in the next half hour. Rocket launch for us is a VIX of 17.72. Maybe it was a bear market ending in October. Stay with us through the morning. This is Bloomberg.